going from RefGo to working for basically Paul Tudor Jones. I jumped the gun.
That's awesome. Before we get into you meeting Paul Tudor Jones, which we're obviously going to spend a little bit of time on, I want to pick up on your mention there of becoming very consistent. How were you able to become very consistent? Can you relate that to anything? Was there anything you did which really helped you to get that consistency?
Yeah, I can. It's very, very interesting. There is a fabulous book called Reminiscences of a Stock Operator. And it's by Edwin LaFay, and it is an absolute classic. And I every one of my traders that have worked for me have read that book at least one time, if not more. In that book, there's one of the stories when the head trader, Larry Livingston, basically goes bankrupt, loses his money. He comes back with a stake, and he's only really can trade one thing and one time, and he has to be right. If he's wrong, he's basically completely done. If he's right, he'll get a bigger trading line, and he can come back. And the thing is about that is that if you think about it, I kind of back then did the same thing. I would say I would wait for every single thing to line up before I made the trade. Everything. So I wouldn't just take good trades or what I thought were going to be a good trade. I would take great trades, and I would put the probability of being successful completely in my corner, if that makes sense. And instead of just throwing darts and being all over the place, that's kind of what I did, back in the beginning, is that I just superly made sure that everything lined up. And it's kind of modeled after what he was able to do or what he did in those books.
So I guess in some ways it was about being very strict and very disciplined in picking the sort of trades that aligned with your plan. Is that a fair statement?
Absolutely. Absolutely. And that is absolutely critical to have your game plan and be able to be extremely disciplined and not be influenced by, noise or something else. And that was a huge key for me. And I learned that really early on. And to this day, it's the same thing. And to be successful and to survive, you have to have the utmost discipline and, basically a rigorous game plan that is well thought out before the trade's put on.
All right, Larry, well, tell us about how you met Paul Tudor Jones. How did this come about?
So after a while working for RefGo, I started to put together a fairly decent track record. It wasn't over the course of years. It was over the course of maybe 9 months, 8 months, something like that. But it was very, very consistent, and it was very, very good. And I got introduced, not specifically to Paul, but somebody in the Tudor group, and I think they had started a program a year earlier or 2 years earlier, and they were, from my knowledge, they were picking approximately 20, 25 traders that they thought would be good, and they were going to allocate money to them, and those traders would basically trade piece of Paul's funds, if that makes sense.
Okay, and that's what you did?
Yeah, so I was accepted into the program, and literally I left RefGo, and I started to trade. I started to trade for Tudor, yes.
Okay. And whereabouts were you trading? Were you trading from an office? Were you trading on the floor at that stage?
Yep. No, I was trading. I was trading off the exchange floor, and I had a little office over at the same firm. I had an office over at RefGo, and that's basically where I was trading, and that's basically where I did my trading. And I continued to do the same thing, very disciplined, watching the markets, looking at the markets, and picking my spots where I thought that momentum would carry the day, if that makes sense. And I was still using, the basic technical stuff that I had taught myself that was working, fairly decently across all markets. It wasn't like it worked in one market and not somewhere else. It worked across the markets. It was the same, human psychology that when it exists, it doesn't matter where it is, it exists.
And did you have much interaction or much to do with Paul during that time while you were trading his funds?
No. We were basically a complete, we had spoken to people within the group, and I can tell you a story about that, but we were basically had no guidance at all from Paul. We were completely separated from them, from what they were doing, and we existed basically on our own.
Okay, right. Yeah, I'd love to hear that story that you hinted at.
Well, sometimes things are Paul's known for being completely a genius, and he is. And I remember back in the old days, they used to have faxes instead of like emails and stuff like that. And I remember that one day I went over to the fax machine, and there was a piece of paper that came through the fax. And I just was talking to one of the other traders that I think was also managing money for them. And lo and behold, it looked like it had a list of all of the traders' positions. And you started to put one and two together, and you could see, here was something that you're out trading for him, but you realize that the genius part of it is he's building a sentiment indicator or something to see where traders may lie. So, for example, if everybody was long cocoa and, somebody in their group would know that, that's valuable information. Because if we're all long, then maybe, a lot of other people are long. And it kind of dovetails with the end, what I call the end of those pressure points. And the market started to get a lot choppier towards the end of that. And I always wonder if it kind of runs amok between the two, if that makes sense. Everybody was trying to game something else.
Yeah. So he was trying to, when you describe it as a sentiment indicator, you're talking about amongst the traders who he had funded?
Yeah. So he had funded traders, and, obviously he keeps track, somebody in there was keeping track of everyone's positions, and it just gives really, really good information to, to an amazing trader, to somebody, a great trader. It just gives more and more information about what other people are doing in the markets, as opposed to what people say they're doing in the markets. These are what people are actually doing in the markets in their positions. So we probably weren't supposed to see that fact, but it was nonetheless, it was interesting. And for me, I was always, which started again in the 1987 when I was watching, I've always questioned things. I always ask why is something happening? Why is a market moving? What's going on? And, you question everything. So you start to see that, and it's just, it's like, wow, okay, you can get valuable information if you know what other people are doing, and it's ingenious and it works.
Yeah. And even though you didn't have a great deal or a great amount of interaction with Paul himself, obviously you were very familiar with who he was and the sort of level that he was trading at. Was there anything which you picked up or you noticed about him that really made him such a legendary trader?
Just the stories that, basically that everybody heard, starting down in the New York Board of Trade when he made some unbelievable trades in cotton, and obviously the stock market crash of 87. If memory recalls, I think he made like 25%. He called it. He had an analog model that matched up with it pretty well. But, for the most part, people that have existed for so long in trading, it's definitely cool to see not only how they evolve and what they do, but, how they do it and how they go about it. So no real dead secrets from what they're doing, but they're very, very good, obviously.
So you spent a bit of time trading Paul Tudor Jones, his funds. You then went on to trade the funds of another market wizard who will remain unnamed for now. But tell us a little bit about how that opportunity came about and what sort of things you were doing at sort of the next milestone in your career.
Yep. Well, that actually, the other market wizard came several years later. it is something that actually your viewers might find interesting with Paul. If you want to just go back for one quick second.
Yeah, sure.
So I think this was the third year of his program. And I had remembered speaking to the other traders that, and again, I was 22, 23 years old. At the end of the year, the successful ones not only got paid, but they were getting this, I think it was like $10,000 bonus. So obviously I was very, very excited. I had a decent year. And I remember I'm sitting home, living in New York City, struggling, rents are high, all like any other young 22-year-old would be thinking. And I remember getting this box in the mail. And it was a little white box. I think it came like, I don't know if it was FedEx or it was in the mail, but it was a really cool looking box. It happened to be from Paul Tudor Jones. And I opened up the box and it said, "Congratulations. Paul's making a donation in your name to his new charity that he's starting, known as the Robin Hood Foundation." So here I am, I'm 22, and I'm like, are you kidding me? Like, I need the money. I needed that money. Looking back, obviously, it's the greatest charity in the world, unbelievable charity. And, but it's just funny because some things have a way, some things when you look back, like they become major milestones. And for me, needing more money for me became a major milestone. And that box, literally, when I got that after that, I literally really, really thought about trading off floor. And I had a friend that was literally begging me every single day to come and join him. And he was working on the American Stock Exchange and trading stock options. And after that, I actually left and joined him on the American Stock Exchange, where we ran a huge group. And I know that you had one of the Blair Hull traders on that I think was doing it in the P Coast. And but the American Stock Exchange, and I don't know if you want to talk about that, was a little bit different than the P Coast, but very, very interesting nonetheless. And for the next 5 or 6 years, I ended up trading on the American Stock Exchange and running the largest group down there at the time. Okay.
And what exactly were you trading on the floor there?
So we ended up having guys that were trading literally we would put people in every single market, trading equity options, and completely different exchange. So it was the first time I was actually on a floor or on an exchange. And the way it was set up was really interesting because you didn't have to think at all. The specialists would do all the thinking, and they were required to basically give 40 to 60% of any trade that came in out to the crowd that was helping to assist the specialist. So the guys in the ring didn't have to really do anything. They would just be handed trades. And it was interesting because it was very, 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 it was not so competitive, very, very, very easy to make money, not knowing what you're doing. And we had guys making just really ridiculous money, never asking how they're making it or anything. And just because the specialists would be giving them tickets and they would be getting trades that were basically guaranteed winners, if that makes sense, with very, very little risk. So obviously what we did is we went out and hired as many guys as we could, and we put them in all the different markets, all the different equities, and we basically ran a giant book because of that. And they were just down there. Some of them, did question what they were doing and tried to learn. But it's funny because out of the 50 guys that we had working for us, I think maybe one still trading today, which is interesting in of itself. And the rest of them are gone.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So I mentioned before a market wizard who is the second one who will leave unnamed. Was that the trader who joined on the floor?
No. So after the American Stock Exchange, things started to happen towards the end, and your other trader was talking about it basically on the PCOS, for example. On the old days, the American Stock Exchange had no competition whatsoever. So for a stock like Circus or IBM or Intel that was listed down there, there was no competition. So if somebody wanted to trade an Intel option, they would have to come down and see the specialist on the floor of the American Stock Exchange. The trade would occur, and that was it. What happened a couple years later, and this is the reason why a lot of these traders no longer existed, was all these other exchanges started to trade these same stocks that were traded on the American Stock Exchange. So all of a sudden, where the spreads or the bid and offer was $0.25 wide or $0.50 wide, started to become an eighth wide or a dime wide. And all of a sudden, what was very, very easy no longer was easy. You actually had to start to think about what you were doing and why you were doing it. And that competition literally killed those floors. And the American Stock Exchange was no different. All of a sudden, we had the Boston Exchange, you had the PCOS, you had the CBOE, and all these other exchanges were listing, basically were breaking up the monopoly that the American Stock Exchange had. And if you didn't really know what you were doing and how you were doing it, you were kind of in a little bit of trouble. And for me, after X years with that, I ended up going over to what was then the New York Board of Trade. And on the New York Board of Trade, I ended up going into, believe it or not, the frozen concentrated orange juice pit. And I don't know if you ever saw the movie Trading Places, but it was very, very similar to that. So I ended up going to a completely different exchange where the rules were completely different than the American Stock Exchange rules. And this is the first time that I would say that there was basically real trading. This was complete open outcry trading. You had to be first, you had to be fast, you had to be the best price. And survival was basically, nobody was handing you anything. Survival was no guarantee. You actually had to be able to think, make complicated two-sided markets at times, and completely different puzzle, if that makes sense, than it was on the American Stock Exchange. And you also, Aaron, which is interesting, but you had to be very anticipatory, if that makes sense. You had to think about your position, not necessarily how it exists today, but how it would look tomorrow and a week from tomorrow, and try to figure out the best way to balance that position off. So it ended up being a completely different experience being on that floor.
Just so we don't leave any loose ends, Larry, I definitely want to speak to you about trading orange juice. But your involvement with the second market wizard who we referenced, what was the involvement there? Was that in relation to the frozen orange juice? I mean, just so that we, can tie that off and keep moving.
Yeah, so basically after, the second market wizard comes into play a couple of years later after the floor. Not after the floor, towards the end of the New York Board of Trade. There was like a 3-year period where there was the second market wizard did not yet appear.
Okay.
Yeah,
sure.
That's why. Sorry, that's why I didn't bring that up yet.
Makes sense. So how did you get into trading frozen concentrated orange juice? I mean, it just seems like such a random thing to trade. I mean, I know it's a real commodity, but why is it a tradable commodity? Like, how widely is it actually used?
Well, it's not really widely used. Believe it or not, they use it in the prison population. That's usually what they were using it for. But the market at this time in orange juice was fairly crazy and fairly active. There were a lot of players, and there were some very, very large players, off floor that actually needed the market to hedge. There was no fresh orange juice market at the time, so they were using the frozen to basically hedge their fresh. And for us, it was great because there was tremendous order flow, tremendous things were going on there, and a real theme started to occur. And it had occurred for me throughout my entire trading experience, but it really started to become concrete on that floor. And the way I think about it is that, and they always say, when things that should happen do not happen, that is such a big information piece. There's so much noise on the trading floor. When you come onto the trading floor in the old days, there's just so much. It's so chaotic. If I brought you down there or somebody came down there, you wouldn't realize you would just hear noise and screaming. But in that, some of that is very, very valuable information. And I think, and I know I'm getting random here, but I think that you're seeing it like today, where you have so much information and so much different data coming at everybody. It's very similar to the trading floor. It's very, very similar to the trading floor. And the best traders were able to figure out what true information is and what information will be impacted in the market versus what noise is. And too many people get carried away with noise. They'll see something on the tape or this or that versus what true information is. And the true information is what we are seeking to achieve and basically looking to model. And that is literally the biggest key.
So how are you able to differentiate between the two? I mean, I guess that's where it becomes really tricky, is actually differentiating what is noise and what's information or signal.
Yeah, and that really comes from a couple of things. It comes from, and I'm actually I'll give you an example. So we were down in orange juice and we were in the pit, and there were a bunch of order flow started to come into orange juice, and they were buying massive amounts of call options. Basically, they were making a quote unquote bullish bet on the future price of orange juice. And they were doing it in such a big way that the price of orange juice should have been moving up at this time. I think coming into the thing, we might have traded, for example, 1,000 options a day. During this 3-day period, we were trading 5,000 options a day, 6,000 options a day. So it was so extreme, and it was just straight out call buying, buy them, buy them, buy them. And the price of oranges should have gone up. And all the guys, I don't know, how familiar we want to talk about options, but the guys in the pit, the floor traders that were making markets and selling these calls had to buy futures to protect themselves. And the call buying was so fast and furious that everybody was raising their implied volatilities to protect themselves, and they were being forced to buy more and more futures. Well, that was all fine and dandy, and my partner made a great point. 2 days later, the futures price did not move at all. Completely didn't move. That bit of information was absolutely critical and huge. And I'll tell you this, a month later, orange juice lost 50% of its value. It absolutely got imploded. And Aaron, I see it today. So take that one little example of something that should have happened that didn't happen. And we see it today. We see it. Sometimes you get exogenous call buying, for example, in a stock. Okay. And we had one a couple weeks in Starbucks. We had it a couple weeks ago. They came in and they're buying massive amounts, abnormal amounts of call buying. Stock price doesn't move up. That's huge information. 2 weeks later, the price of Starbucks goes down pretty big, $6, $7. So it's being able to use huge information and the correct information. And the best information is actual impacted information. So these were people that were coming in and they were buying call options and they were putting their money down. And when things don't happen that should happen, that's when there's real money to be made, when the markets literally go the opposite way. And by the way, if you think about it, look at the election that we just had with Trump. Everybody said the market should be down and down big, and it should have been a bloodbath, etc. And when it wasn't, that's information. So it's basically, it's every single day, it's every trade, asking yourself what should happen and what did happen. And if you start to think along those lines, all of a sudden you start to see what's working, what doesn't work, and you could start to model sort of correctly, as opposed to modeling based on, okay, if a market, for example, closed lower 9 days ago, and and the RSI is above a certain level, we'll buy the market. I mean, that's just back testing stuff, where this is actual market information.
So in these couple examples you gave here, you said that the price should have gone up because there were so many people taking bullish bets and buying options. Why did the price not go up and barely move at all? Why not?
So what most likely happened was that smart money came in to buy those calls because in reality, they wanted to protect themselves. They wanted to short the futures and have, God forbid, protection if they were wrong, where the calls would basically stop them out. And they came in and they probably, for every call they bought, they would sell a future. So the futures were not moving up as they should have. And the Starbucks example was probably the same thing, where they came in and they buy thousands of upside calls. And you know what? The price isn't moving because they're shorting the stock. And they could be shorting the stock for any slew of reasons, but there's a probability that could be smart money, if that makes sense, or insiders or somebody that knows something that's going on. And not all the examples work like that, right? Sometimes they come in, they buy all the calls, and the stock moves up. That's fine. That's what's supposed to happen. So it comes down to when something's happening that should not happen. That's what should pique your interest, and look at it that way. That's where real opportunities to make substantial amounts of money lie, when something doesn't happen and should happen.
And when you're talking about smart money and you're referring to other participants as they, who are you actually talking about in these examples? Like, I know you don't know specifically, but like a general idea, like who are you referring to here?
So like in the case of orange juice, there would be smart money would be considered somebody that's actually producing the orange juice crop, and they actually have oranges. They know, they have better information than anybody. They know, what the demand is. They know how much they're selling, and they know they can look out their window and see, how big their crop is. And orange juice is an interesting example because it's a very, very small market. And there's some people in there. Louis Dreyfus is the biggest player, and they basically control a lot of this crop. You wouldn't know if you're standing on a trading floor, who's, which order's coming in, who it is. But you look for certain patterns, and you look for how the market reacts to certain things. And, I know orange juice or the Starbucks example is just two small examples, but it's any way that information or data reacts to the actual impact and the price movement of the underlying and what should happen. There's no way, like you said, there's no way to always be able to tell what the smart money is or the dumb money, but you start to see patterns. And you can start to see when you watch news, for example, or different data, that some of it doesn't move the stock, and other times other information does. When we stood on the floor of the American Stock Exchange, if somebody bothered to pick their head up, there were times when there would be 50 brokers coming in to buy, calls or puts, or come in for a reason to buy a stock. Other days, nobody would be there. And I've always said, and we've always tried to model, well, why are brokers coming in today to buy this stock? And you backtrack. You say, okay, let's figure out why. Was it a technical point that came out in the market? Was it earnings? Was it some news? What was it that is impacting that price? And I say this because I want to say, as opposed to looking back and saying, okay, IBM went up 3 days in a row, so therefore the next day should be down. That kind of model, if that makes sense. The models that we look at here, what I'm doing now, and the models that we've developed deal with actual things that are happening, informational and data in the markets versus what should happen, if that makes sense.
Okay. Yeah, no, it does make sense. It does make sense. So let's say you spot some of this activity, which seems kind of unusual. Mm-hmm. How do you actually plan a trade, and how do you actually trade based on that information? Like, how do you actually capitalize on what you've observed?
Well, in the case of the ones that we just spoke about, so you would we would basically let a little bit of time go by and see what happened. And we know when we model it that, X, Y, and Z should happen. In those two cases, in orange juice and Starbucks, for example, just to use those two and just to use this one form of information, because there's a lot of them out there. Just to use those two, over the next day or so, both of those prices should have moved higher. So orange juice and Starbucks. Both cases did not happen, and actually both started to go down. So that was the tip-off to a trade. Now, how you express that trade, that's really dependent on the risk tolerance that you have, whether you want to go short it, protect yourself with a call, or if you were long, you may be realizing you might want to get out because the probability has now changed in that marketplace. And, how basically you want to do it, you can short it or whatever. That's really up to the individual trader and how they do that. What we do here is we obviously, you have to have a point where, even if you have that information, you have to have a point where you're going to be wrong. And if you're wrong, you have to get out. And that's the key. And you're dealing with probabilities. And one of your Edward Thorpe, who you interviewed, who's amazing, talks about in the casinos how he would change his bet based on probability. When there was a lot of high cards, he would increase his bet. When there weren't, he would have a lower bet. It should almost be no different in the marketplace. When you have information that a price is not doing what it's supposed to do, after you look at thousands of cases, you start to develop a probability of an event likely happening. And if you can weight that probability, you can also weight your bet size so that you have a bigger bet size for a higher probability event occurring. Having said that, you'd still have a stop in place that if you were wrong, but no different than, what he was talking about on the casino if you were counting cards or something like that. So it's all about having a probability, and the way you get a probability is to have been able to go back and look at as many cases as possible as you can find. We've looked, just so you know, rough and dirty, over 80,000 cases. And with that, we are able to put together a fairly good probabilistic point of view as to what should happen in a market. And we can vary our bet sizes based on that information.
Now, you said that these sort of opportunities can lead to massive rewards. When you were trading frozen orange juice, how much would you say these opportunities made up your profit at the end of each year? Like, I don't know if you have any numbers on that, but just like a rough idea.
No, that's a great question. So we were in orange juice. I ended up becoming, my partner ended up becoming the largest traders in orange juice. And it's funny because there was a magazine called Trader Monthly, and I don't know if you're familiar with that or you ever heard of that, but it was actually a pretty famous magazine. They no longer exist, but they had called, I guess, randomly up to our clearinghouse, and they had asked if there was anybody that stands out that they should speak to, and they brought up my name, and they did a feature in Trader magazine on me and on orange juice, and that led to other opportunities, which I don't know if you want to get into, but in terms of your specific question, we were able to generate very large, very consistent profits. I would say that event that I told you about in orange juice might have occurred in that one specific market probably once or twice a year where something didn't happen that should have happened, and we were able to capitalize on it in a pretty big way. I would say that probably led to 20% of our profits from those events. And the other 80 was doing our thing, filling in the puzzles, being anticipatory, and, buttoning our positions and making, size markets. The beauty is you're on the trading floor and there's only, I'm trading an orange juice. I have one market. Where now, it's funny because you go off floor, I have 7,000 markets theoretically. We have 7,000 stocks that we can look at and apply the same edge that we were applying in orange juice and apply them to 7,000 different stocks. So it's kind of very, very interesting in a weird way, but all the building, you can't just come and say, okay, I'm going to trade, 5,000 stocks. You almost have to figure out what you're doing and then see if you can apply it towards many different things, if that makes sense. Being in orange juice for X years and then being on the Amex and trading one or two stocks, kind of allowed me to see, well, why would this stock move today? Why were brokers in here today? What were they reacting to? What are they looking at? Why is something happening? And I think, that's a really important thing about being successful is to kind of ask yourself, the whys instead of just blindly doing something, if that makes sense.
Do you think it's important to always understand why a certain move is happening or why a stock's moving a certain way? Or do you just kind of need to be able to react to it?
It's a great question. It's a combination. My biggest issue was always taking profits too quickly and not letting it run long enough. Knowing why something is moving would allow that person to probably stay with the trade longer. if that makes sense. But in today's world, there's no way to you're not really ever going to know for certainty why something is moving. So it's kind of like a caveat. It's kind of like, yeah, it'd be great, but the reality is it's not going to happen. So the most important thing is to know when you're wrong and be able to be disciplined to get out of it and structure the trade in such a way that no one trade is going to really hurt you. And, to be able to put together a string of those trades where you have, 60% probability, 65% probability of making money, and you can put together 50 of those, each day, or 20 of those each day when something is going on, and just to use that one example where it shouldn't be going on, and you pick that up from 2 days of work before. Well, you start to build a portfolio of that. Yeah, you're going to have some losers, but you're going to have an awful lot of winners too. And you're not going to always know why or who's doing what. You're just going to, follow along, if that makes sense, and you're going to get in gear with the market. And I don't mean to keep using those two specific examples because there's tons of, different news that may move a market or may not move a market. And if you just sit and you ask yourself, what should happen and what is happening? And if it differs from what should happen, that's where the opportunity lies. So when Trump won, the market should have gone down, but it didn't. That told you something. So, how you play that accordingly, forgetting your views if you were bearish, but that's information. So if you have a list of things that you think should happen, when they don't happen, that is such valuable information, even from an individual point of view or trader, that you can totally take advantage of that and absolutely make money.
Yeah. I like how you keep emphasizing this point. I think it's really valuable, and I think you're doing a great job of explaining it to us. I think it's good that we keep referring back to the same examples as well, because it adds a lot of context. So, I appreciate that, man. That's awesome. So tell us a little bit about how you're trading today. I think you've probably already described it to a certain extent. Is there anything else which you're doing, working on? Give us the 1,000-foot view on how you're actually trading today, like your sort of universe, your time frame, that sort of thing.
Absolutely. So we have taken what we had on the trading floor and the observations that we have seen on the trading floor, and we have figured out a way to apply them to basically, we're trading equities now. So, and a lot of these equities trade like commodities, as you know, because we spoke about it earlier, these HFTs, the way they trade, they move in and out of markets so quickly. These stocks are moving around like commodities, but we have taken what we had, this quote unquote edge or alpha, and we have been able to apply it to 7,000 domestic stocks here in the United States. And we build portfolios every single day on long and short, and they all have a fundamental catalyst. So there's a reason why these stocks should go up and or down. And we build a balanced portfolio. So it's long, short, that's basically completely balanced, so that we're trying to capture, basically that VIG or that extra edge. And it's all based on short-term fundamentals that we can quantify. And we know from looking back, basically for 20 years or 15 years, and we can go back and look at, I think we looked at 86,000 different data points for these names and see how a fundamental change or a fundamental news would move an individual stock up or down over a very short period of time. And I bring up the HFTs because had you been running a portfolio like this in, let's just say, 15 years ago, your holding period on the portfolio might have been 2 weeks because stocks didn't move as fast as they do today. Well, today, at our fund, we hold our portfolio for approximately 5 days. That's it. So our portfolio is completely turning over continually, and it's all based on stuff that we had spoken about earlier. and how to identify that, but also other fundamental catalysts that diversifies that portfolio out.
Okay. Now, you mentioned that you've got 7,000 stocks in your universe. How many names would you be holding or a position in at any given time?
Great question. We approximately hold, I would say, 80 to 100 longs and 80 to 100 shorts at any given time. Out of the 7,000 stocks in the universe, and I mean all the different exchanges, you have to weed out for liquidity. So you're probably going to be left with, let's say, 5,000 stocks. Out of those 5,000 stocks, we probably get signals on 15 a day that, to be bought, and 15 a day to be sold. So out of thousands of stocks, there's only 15 a day that'll meet the very, very strict criteria that we are specifically looking for and trying to capitalize on. So it's yeah. And you know something, Aaron, which is crazy, but in the old days, there was no way to do it. Computing power today is so great. Our computers literally go through thousands of data points, and it can do it in literally a minute. And it can literally spit out to us the ones that we need to take a look at. So, and I don't know if you could have done that 10 years ago. I think it would have been very, very difficult.
Yeah, definitely much slower, that's for sure.
Yeah.
As you bring that up, and you're doing a lot of modeling now, and you're looking at such a wide universe of equities, has that required you to learn completely new skills, since coming off the floor, or have you just hired people to do this for you?
That's really a great question. I am not per se a programmer. So we have a small team of 4 different people in here, and one of them programs, but we've also used outside programming to do it. I am literally like complete old school. Like if you saw my desk, I have yellow pads on it. I write down notes. I think, I'm watching the markets and seeing what's going on versus what should be going on. And I take all of those ideas and then they get spun to the programmers, and then they write up stuff and we look at it. It's one of the things I wish I had the time to do, go back and learn how to program. But thankfully, the younger generation can do all that, and they do for me. It's great.
Nice. I just want to go back to a point and speak about it a little bit. Why do you want to run a long-short portfolio? What's the advantage of doing so?
The advantage for us is that, it was like, for us, we knew the floor was coming to an end, and everything was going electronic. And we had seen so many cases, and I saw it from the American Stock Exchange. We had 50 guys working for us, and nobody was able to kind of make the leap to the next level, or off the floor. And we had such really good observations throughout the 20 years of trading that we knew if we can apply what works on a trading floor, but figure it out to doing it off the floor, that it could be really, really interesting. And again, a lot of it comes down to, because instead of just trading one market, you can trade, X thousands of different markets. And for us, we kind of got lucky in a weird way that it all, that kind of all lined up, that these notes, the reasons why brokers were in there, the reasons why they were buying or reasons why they were selling, they didn't just wake up one morning and say, oh, I want to buy XYZ today. There's got to be a reason. There's a catalyst for it. And we were able to go back and figure out, we had what we call positive expectancy on the trading floor, where every time we did a trade, we mathematically can quantify how much we should make on the trade. Now, not every trade is going to be a winner, so it's over the course of time to figure out exactly mathematically what your edge is. And we were able to take that from the trading floor and bring it off the floor and mathematically quantify. Each time we do a trade, we know that over a course of time, we're going to make X, Y, or Z. With the losses, with the slippage, with the commissions, everything built in. And that's kind of cool to see. And for me, it all comes back to sitting down in that basement and literally watching the stock market crash that hooked me 30 years ago. And I'm still hooked to this day. And I remember, Aaron, every single Friday on the floor, I would be so depressed. I would leave the floor on Friday so depressed because there was no trading on the weekend. And I'd have to literally wait till Monday morning to get back there. And it's weird, but I mean, I feel like kind of the same way. So I wake up every single day just so excited. We're basically become obsessed, which is good and bad. But I basically, for 30 years, completely obsessed, about the whys and what's happening and why it's happening, and try to look at ways to make money.
And how key do you think your passion and your obsession, as you describe it, for trading has been to get you to where you are today?
I think that my personality, I think I never, it's like, it's weird. You see people sometimes give up. I will always keep coming back for more, if that makes sense. I'm always trying to learn, always trying to get better. And I think my personality completely fit into that model. And always, like I'll go home at night and I'll spend an hour and a half and I'll go through the entire day. And I don't get lazy about it. It's almost like a workaholic kind of, background that I have. Like I just don't stop. My wife's not happy about it, but, and I think that's helped me.
Now, Larry, I want to ask you a question. So, someone like yourself who's been involved in trading for, around 30 years now, it's a long time. I think what I've done in the past when I've spoken to traders who have been trading for similar periods of time, I've asked them sort of like what things have changed over that period of time, what things have changed over the last 30 years. But I was having a conversation with Jeff Davis, who was on, I think he was originally on episode 70. Anyway, we were speaking and he sort of said to me, one of the things that's really important is what hasn't changed, what's stayed the same. So I'd like to ask you, over the 30 years that you've been trading, even with all the changes that have taken place, what are some of the things which have remained the same after all this time?
Yeah, that's great. It's great to look back and think about that. The reality is that it really, and I hate to say this because you're trying to, after 30 years, you want to say, wow, I'm so sophisticated and this, that. The reality is the human nature is not changing. Fear and greed, it's exactly the same. There's still elation when you're right and despair when you're wrong. That's not going to change, and that's never going to change. And the things that work, it's funny because a lot of things that work will continue to work as long as it's based on the right premise. And I think that's, and I know we came back to it, but I think that's just so important. And for me, like 30 years ago with pressure points and things like that, that's important. And that stuff still works today. Maybe the movement happens faster now where you'll make money faster or if you're wrong, lose faster. But, you can adjust to that, right? All you have to do is lower your bet size down, lower your risk down, and you'll be in the same spot you were in. So, the old saying is the markets change, but the markets always change and the markets always stay the same. And I think the successful traders kind of come back to the bottom line is, why is it going up? A stock or a commodity or futures is going up today, probably for the same reasons it went up 5, 10, 15 years ago. There's a reason that for one day there are more buyers than sellers or vice versa. And that's just not going to change. And, you can go and people can go and model things like that. But the reality is it comes back to the basic human nature, fear and greed. And that's not going to change. And that book that I mentioned, Reminiscences of a Stock Operator, let me tell you, when you read that, it's just eye-opening because those stories are exactly the stories that you will have today from trading. And you sit there and look at it and you go, oh my God, this is 70 years ago. How can that be? They didn't have computers and things then. But you know what? They're exactly the same. And it's pretty cool. That's probably why I've been doing it so long, because, like we said before, I'm not a programmer. So if it was all just programming now, I wouldn't exist. I wouldn't have been able to adapt to that. But it's not. And it does come down to, what's worked and observations. And for me, that's been completely key.
I really need to read that book. I know a lot of listeners are probably shocked right now. I've been saying it for a long time, but I've never read that book, and it just keeps coming up all the time. It's just, the problem I have is there's so many books I want to read, and I'm not the fastest reader. So it's all about, certain books taking priority, but I think I need to move this one up the list. Anyway, Larry, let's leave it at that for now. I know you don't have a great online presence. Is there anywhere listeners can go to find out more about you?
Yeah, you know what? It's funny that you mentioned that. One of the guys that works in the office, I've always really, really kept a low profile. And I did that for a whole bunch of reasons. My love is the markets. And I'm not on Facebook. I'm not on anything. I am on Twitter, and I am going to update all my stuff. It's going to be updated in the next 24 hours. I will get a social presence going, and there will be ways to get in touch with me. I have an email I can give you, and you can do that if that wants.
I mean, it's up to you. If anyone wants your email, just hit me up, and I'll share Larry's email with you. That's probably the better way to do it. But do you know what your Twitter handle might be?
I think it's the name Larry Allentoff, but I will. I'm on Twitter all the time, but I never reply. Not that I don't reply. I'm like a much better listener, if that makes sense. I'm always taking in information, and I'm often not sending out information. But it's under, I think it's Larry Allentoff or Larry.Allentoff, but I can definitely text you back or send it through the Skype.
Yeah, we'll work it out. We'll put a link to it in the show notes, because I'm sure some of the people listening to this will be keen to follow you. So
I'm definitely on Twitter. So like if you put my name into the thing, it will come up.
Okay, cool. And I will also just mention you were on season 2 of Wall Street Warriors. All 10 episodes of that can be found on YouTube as well. So I'll also post a link to that in the show notes. Larry, thank you very much for coming on the podcast. It's been an absolute pleasure to have you on. Thank you once again.
I really appreciate it, Aaron. You're doing great work here.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that? And now that means you can solution to
get low commission. Trade Inc.
Ladies and gents, you're listening to episode 118 of Chat with Traders podcast. If by chance this is your first time listening, then welcome. I'm your host, Aaron Fifield. Joining me this week is a very special guest, high-speed trading veteran Manoj Narang. Manoj worked on Wall Street for the likes of Credit Suisse and Goldman Sachs before venturing out onto his own to found TradeWorks, which became one of the larger trading firms in the US in terms of volume. He's since parted ways with TradeWorks to start Mana Partners. Mana is a quant fund which raised almost $1 billion for its launch in January this year, 2017. As a brief summary for some of the things we got to chat about, the value of the actual technology which drives some trading operations, capitalizing on the explosion of data, and my favorite part from all this, towards the end when Manoj gives advice to aspiring traders. Now, understand this particular episode may not be for everyone, and if some of the things discussed are a little beyond your understanding, I've actually included a few links for you as further reading in the show notes at chatwithtraders.com/118. Also, I'd like to mention I'm heading to New York at the end of April. I'll be attending and also doing an interview at Quantopian's event, QuantCon. So if you're going to be there, please let me know. Or if you're going and don't have tickets yet, just hit me up and I'll make sure you get a discount. I'm also going to be doing a bit of a Chat with Traders event / get together while I'm there in New York, which is going to be really cool and a little bit special. I'll have more details around this by next week, but just wanted to give you the heads up for now, so please stay tuned. And now let's cross over to the conversation I had with Manoj Narang. It's been a long time coming. Let's just hit record and get this going. So, Manoj, I've got to say, straight out of the gate, you've probably been one of my top 5 hardest guests to get an interview with. So it's good to be finally speaking. You've been busy. What's been going on?
Well, turns out launching a new quant trading initiative is a lot of work.
So you have just launched Mana Partners. That launched in January 2017. What does that feel like? Is it a relief?
It's not a relief. It's very exciting. We still have a lot of work ahead of us, but we're very optimistic.
And since you decided that you were actually going to launch this fund, Mana Partners, from that moment when you had the idea, when you actually decided this was something you were going to go ahead with, up until the point of when you launched earlier this year, how long is that period of time? Like, how much work actually went into this? Like, give us an idea on sort of the scope.
Well, so I left my previous firm, TradeWorks, in January of 2015, and I had a 6-month non-compete. And during that time, I had tons of different ideas of what I would like to do down the road, and I thought about what it was that I wanted to do, and I couldn't really narrow it down to one specific thing. And so, towards the end of that year, I sort of decided that, quant trading was the way to go, mostly because I've found quantitative trading to be a very effective means of producing intellectual property that, has a lot of value. And so, I've always been fascinated by the ability of this business model to generate IP that could be commercialized in a multitude of different ways. And, I had a lot of success with that at TradeWorks, commercializing various kinds of technology that, came out of the trading business. So, for me then it was basically, experimental, but having seen firsthand the fruits of that effort pay off, pretty much all in on that concept at this point about using quantitative trading to catalyze and inspire the growth of new technology, and also, frankly, to fund its creation and battle test it to an extent. And then, one of the things I've learned in my career is that the technology or the IP that you build in the course of operating such a business has significantly more value than the P&L that you can extract from the markets just from quantitative trading alone. So that's really what Mana Partners is about. We are basically a incubator of new businesses that leverage the firm's IP. And in that calculus, certainly quantitative trading has primacy in that it is the catalyst and the inspiration for a lot of the other businesses based on the technology that gets created to satisfy the needs of that core business. So that's essentially what we're looking to do. And, in the process, we believe we're the first firm to bring high frequency trading to the asset management investor base. Typically, high frequency trading strategies have been operated by proprietary trading firms using their own capital. And to the extent that they've needed to access outside capital, they've gone the venture capital route or the private equity route or the angel capital route. The business model historically has not been conducive to the asset management sphere. And, generally asset management investors are not even familiar with or comfortable with some of the key precepts of high frequency trading. They're not familiar with the performance characteristics. They're not familiar with or comfortable with the idea of double-digit Sharpe ratios. Traditional notions of capacity of quantitative strategies don't apply. So it definitely is an innovation as far as business model goes, but it goes much further than just bringing high-frequency trading to the masses. We essentially want to do that in a way that allows us to turn technology into a profit center rather than a cost center.
I'm really keen to talk about Manor Partners and some of the things you're doing there in much more detail very shortly. But before we get into that, before Manor Partners, before TradeWorks, how did you first get involved in trading or even financial markets for that matter? Like, where did you start out?
I started out at First Boston before it was rebranded Credit Suisse First Boston. That was in 1991. So I worked on their equity derivatives desk and working on program trading systems. And so I was a technologist, a front office technologist, supporting the program trading desk directly. And, I floated around Wall Street for a while in a variety of different roles, initially technology, and then more on the research side, and then ultimately trading. And so, had roughly a 8 or 9 year career on the street before launching into my own entrepreneurial activities.
To get those positions that you did have on Wall Street, I believe you had an education in math and computer science. Was it your motive to get educated in those things purely to get a trading job, or how did that kind of work out?
No, I didn't know anything about Wall Street the entire time I was in college. I didn't even know it was a thing. Well, I mean, I knew Wall Street was a thing, but I didn't know it was a thing that somebody like me could have a productive career there. And, in point of fact, I never took a class really that applied directly to my work. So, I never took a statistics class. I never took a finance class. I never took an economics class. So, it was really all just learning on the job, essentially.
Okay, so were those things helpful for you in any way?
Well, computer science definitely was. The kind of math that I studied was very theoretical, things like abstract algebra and so forth. So those, I haven't really found much of an application for it, but certainly the theoretical computer science aspect of it, algorithms and, graph theory and things like that. Generally speaking, being able to reason quantitatively is the skill that you're after. It's not really any specific technique they teach you or anything like that. So, yeah, I think that regardless of how you get it, the ability to reason quantitatively and to think logically is important. Problem solving is a very important skill.
When you say reason quantitatively, what exactly is that referring to?
Well, this is a business which is also known as algorithmic trading. And so, building a trading algorithm, is a quantitative challenge. It's it's a puzzle that involves many moving parts and many moving pieces. And there's all kinds of mathematical challenges. There's all kinds of engineering challenges. There's all kinds of algorithmic challenges. And, people don't naturally have that skill set. That skill set needs to be incubated and cultivated. And, generally people who pursue science and engineering degrees have a chance to learn those types of reasoning skills.
Okay. Manoj, tell us how TradeWorks came to be. You said you did about 9 years on Wall Street. Then you left to start your own trading firm, which was TradeWorks. What was going through your head at the time? What was sort of the motivation to start TradeWorks, and what did you sort of set out to achieve?
Okay, so before I start, I just want to let you know that I would like to speak to you as openly as I possibly can about TradeWorks. However, I do have a separation agreement there, and I'm not allowed to disclose any non-public information about the company. I no longer work there, and I am bound by an obligation to protect the company's confidentiality. So I can speak to why I started the company. That's not their confidential information. So I'm happy to do that, but I just wanted you to be aware of that, that I may not be able to answer every question you ask me about them. So essentially, in the late 90s, I was at Goldman Sachs, which was my favorite job on Wall Street. I learned more there in a year than I'd learned in my entire career up to that point. And it was just a great place to work with some phenomenally smart people. And that said, I was getting to the stage in my career where, I'd learned enough that I started having a lot of creative ideas for how I could apply that skill set outside of just quantitative trading. I sort of had gotten a little bit burned out. I was working very long hours at Goldman. I was doing a lot of trades in an era before electronic trading. And so, there's a lot of manual trade entry and a lot of trade reconciliation, which was also manual. And then at the same time, a lot of coding. And, it was just very, very exhausting. The markets weren't electronic yet. And so basically you had to trade manually over the phone and enter your own trades. And then on top of that, write your systems and code and so forth. So I was getting a little bit burned out on the business, but also, taking stock of the fact that many other people were becoming very, very successful out west, starting technology companies using, the same skill set. So, I felt that there were all kinds of problems that I could solve using the techniques that I had learned in quantitative finance. And what was very exciting about the late 90s was that it was really the epicenter of innovation around retail finance. So, online brokerage had just come onto the scene in the late 90s. And, in a matter of 2 years, it had gone from nothing to around a 40% market share of all retail equity trades. And at the same time, because of the internet and the advent of all these financial portals, all of a sudden the public and the retail investor were awash in financial information that previously was available only to professional or institutional investors. And so I saw an opportunity there. Clearly there was a lot of innovation going on the market access front, kind of leveling the playing field and making it easier for self-directed investors to access the market at relatively low cost, $10 commissions and whatnot. And at the same time, the markets were awash with information. So self-directed investors, whether they were high net worth or active traders, had all the information that they needed, and they had the market access to be self-directed. But what they lacked was the ability to make scientifically sound decisions. So, a lot of the processes at automated trading firms are, based on techniques of scientific disciplines like econometrics or portfolio theory, statistics, multivariate statistics, so forth. So, or algorithms or game theory, however you want to characterize it. But the point is that there are scientifically and methodologically sound techniques for taking data and transforming it into an optimal decision. And these kinds of techniques are very widespread in quantitative trading. And, I had started using online brokerage on my own. I was a early adopter of the Daytech online brokerage platform, which has since got folded into Ameritrade and then TD Ameritrade most recently. But I was using that platform, as early as 1996. And it just occurred to me that it would be possible to build all kinds of very interesting tools that I didn't see anywhere else on the internet, and really, help mainstream investors by running, by providing tools that, were driven by fairly complex methodologies and fairly intensive in data, but which were presented to them in relatively simple form. So, and it proved to be very easy for me to think of these tools. I would be able to, you could lock me in a room and, for days on end, and I could just keep coming up with cool ideas for tools that would be very, very useful for people. So the idea was to fashion a bunch of, dozens and dozens of analytical decision support tools that would solve very specific and simple everyday problems that retail investors had, and then to package these into different verticals that addressed different segments of the financial industry. So that was essentially the idea, and then that was going pretty well up until 2001 when we had the dot-com bubble burst, and we had 9/11, and operating conditions for startups became very, very difficult, particularly in New York and in the financial sector. And so at that point, the company became a hedge fund in order to stay in business. Pretty much has remained that way ever since, although, under my leadership, the goal of the company was not ever to really be the world's biggest hedge fund. It was really to use the hedge fund business model to generate revenue and to generate IP, which could then be used to build other businesses. So TradeWorks is, now the owner of Thesis Technologies, which has become very successful in a lot of different areas related to high-performance trading technology and regulatory technology. So, that notion proved to be successful and bore fruit. Back when I thought of it, it was a little bit heretical and a little bit counterintuitive for people to understand why a hedge fund would also be interested in commercializing its technology. People naturally wondered whether that would cannibalize the competitive advantage, but really I viewed it from a different lens. I viewed it from the perspective of it would be nice to be able to take technology, which is typically a major cost center at other quantitative trading firms, and turn it into a profit center. And, that experiment proved to work. And so, at Mana Partners, starting with that premise that, the best way to incorporate technology into a quantitatively driven and technology-driven firm is to turn the technology investment into a profit center rather than a cost center. So, we look for as many ways as possible as we can to monetize the sunk cost behind the investments that we're making in technology and R&D and data and so forth. And doing so allows us to really have a much bigger technical footprint than we would be able to afford otherwise. So that's really, how this got going.
Yeah, so you started TradeWorks in the late 90s, and it was you were a technology company providing tools to retail. Early 2000s, you became a hedge fund. If I understand correctly, it wasn't until around about 2008 that you actually became active in high-frequency trading. How did that come about, and why the shift?
Yeah, I'm not sure how much I'm comfortable disclosing this, but 2008, it's well known, was a very difficult year for hedge funds. There were a lot of outflows from the industry, and it became very, very difficult to operate a hedge fund in the fourth quarter of 2008 due to the demise of Lehman Brothers and so on and so forth. So, I was looking for other ways to apply our quantitative skill set and our quantitative pedigree. In late 2008, it just was very, very difficult to raise money for a hedge fund. The fundraising environment was very, very toxic, at the height of the financial crisis. So, that was short-lived, but, in the meantime, it became important to try to see what sort of other opportunities were out there. So, late 2008 was an environment that was marked by outsized volatility, and given that capital was hard to come by, a natural way, to try to leverage the quantitative trading skill set was to do high frequency trading, because those kinds of strategies do very, very well in, highly volatile conditions, and they don't require a whole lot of capital to run. So they can be done with, a proprietary trading business model using a small amount of capital. So, that's what we did. And, we're pretty much successful out of the gates and grew the business, quarter after quarter and year after year. And, eventually became one of the larger trading firms in the U.S. by volume.
So just so we have a bit of a perspective on this, how much volume were you trading on, I guess, a daily basis?
I don't think I can disclose that. You may be able to find publicly available information on that, but I'm not allowed to disclose financial information of the company.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
All right, Manoj. Well, I know we've only got a limited amount of time together, so I want to be a bit selective on what questions I ask you. So I just want to sort of jump past this a little bit more and hear maybe some of your more recent thoughts instead of focusing on, your journey up until this point. So you made a few interesting comments right at the beginning when you were talking about Manor Partners. One of those things was that you see the technology of your trading business more valuable than the P&L. I'd just love if you could expand on that a little more. I think that was quite interesting.
I can't really go into stuff that doesn't exist yet, but just, to kind of give you an indication of what this means. Going back again to TradeWorks, when I was there, I really tried to do my best to extract the maximum economic value that we could out of the stuff that we'd built. So there were a lot of technologies that came out of the trading desk. So, for example, the research platform that I used to build intraday trading signals for the high frequency trading business, eventually I ended up selling that to the Securities and Exchange Commission, and they called it Midas. And, it was used for an entirely different purpose, but it was the same technology that I was using to create intraday alpha signals, predictive signals, now being used by the market's chief regulator to better police market structure and understand the impact of electronic trading on the markets. So, that's an example. And similarly, we became very, very adept at cloud computing, being one of the earliest adopters of the Amazon Web Services platform. That's where all of our tick data was stored, and built all kinds of tools around that. And so, Midas and our expertise in cloud computing really positioned us to compete for an even bigger project called Consolidated Audit Trail. There were a lot of large firms like Google and IBM and SunGard and, FINRA, and various others like Booz Allen Hamilton that threw their hats into the ring to compete for that award. This was a very significant financial technology project, probably the biggest regulatory technology project ever. And the goal was to basically build the largest financial database in history and one of the largest databases of any kind ever put together. And we threw our hat into the ring as well. And I felt that having been successful in deploying the Midas system, that that would really give us a leg up on Consolidated Audit Trail. And also, frankly, just understanding what the regulators want to use Consolidated Audit Trail for, and why the system that it's replacing, which is called OATS, which is operated by FINRA, was deficient, namely because OATS was conceived of and developed prior really to the advent of algorithmic trading in any meaningful way. When OATS was invented, order life cycles and trading algorithms were much, much simpler. And it was in the pre-Reg NMS era when market structure was much simpler as well. So, in today's market, the linkages that you can infer from the OATS system are not sufficient to give regulators the explanatory power or the investigative powers that they need to see what's going on in the market. And so the SEC came up with this new system called Consolidated Audit Trail that is, you can view, if you're so inclined, as a natural successor to the OATS system. You can view it as a next generation of the OATS system designed for the modern era of electronic trading. And I felt that, the tools and the expertise that we had built up in-house as a high-frequency trading firm would really give us an edge in terms of crafting a solution that other larger firms, didn't have because they don't do any quantitative trading. And I also felt that Midas would give us a sort of incumbency advantage, namely that you could view Consolidated Audit Trail just as correctly as a successor to Midas, as you could as a successor to OATS. So I felt that, we really had a good chance to win that. And so, I really directed a significant amount of resources at the company towards competing for that contract. And, a few weeks ago, it was announced that TradeWorks and Thesis did indeed win that, which, was very gratifying to see, and real vindication of that approach. So hopefully that illustrates how, you can use technology that comes out of quantitative trading for a whole host of other purposes, but there are so many remaining untapped areas in the financial markets. For competitive reasons, I'm not going to start enumerating them because we're a startup and we haven't, publicly announced our intentions in a lot of these spaces yet. But there's a lot of very, very interesting and big time opportunities in financial technology where, people who have built world-class systems to do quantitative trading, whether it's high-performance trading, electronically, or whether it's, big data technologies, or the combination of those two things. The kinds of advanced technologies that you have to build to be competitive in quantitative trading, which is one of the most hyper-competitive zero-sum matches of competitive talent there is anywhere in the economy. If you can build systems that allow you to extract a modicum of an edge or an advantage in that market, there's a very good chance that those technologies have application elsewhere, both in finance and frankly outside of finance as well.
What would be an example of an area outside of finance?
Well, we live in the era of big data, so it's quite conceivable that analytical tools or analytical systems or methodologies that you build originally on large data sets in finance may have applicability outside finance, whether it's in healthcare or whether it's in e-commerce or a host of other areas that are very data intensive.
Right. Very interesting. One of the comments you made earlier as well is that you sort of said that one of the goals of Manor Partners is to bring high frequency trading to the masses, and what you meant by that is by making it something that's available to more traditional asset managers and investors. So, why do you think that might be appealing for those more traditional investors to have the option to invest in high frequency trading strategies?
I've been one of the more outspoken people in the high-frequency trading space over the years, and I've really done my best to increase the awareness of the public and the press and the policymakers, involved in regulating the space, just to increase their awareness of what high-frequency trading actually is. And, I've been a major proponent of data-driven decision-making, and I've also been, I feel, a major voice of reason when it comes to, the paranoid conspiracy theories that certain corners of the market have about what high frequency trading is. For much of the public, due to, the way the industry is presented in the media and the way that opportunistic, grandstanding politicians have characterized the space, in the way that it's been depicted by some members of the press corps, the public has a somewhat negative, opinion of the space. And it's not negative in the sense that, it doesn't work. It's negative in the sense that, there's a widespread impression by, retail investors, mainstream investors, and institutional investors alike that high frequency traders enjoy certain advantages that are not widely disseminated. And so there's a question about fairness. Now, I happen to believe that, inequality is a natural aspect of any sort of capital system. Capitalist systems reward skill. If you have competitive games, and the market is definitely a competitive game, but if you have a competitive game like chess, even if the rules are well understood by both sides, and both sides have an equal amount of time on their clock, you can't expect equal outcomes. There's definitely different degrees of skill. And, the analogy is that in the markets, people are entitled to study the rules of the markets in as much detail as they want, and they're allowed to invest in technology to the extent of their capabilities, and they're allowed to engineer systems that effectively express their skill sets. And, that should be allowed, that skill. Nobody really complains that Google has an unfair advantage because it has by far the best search engine of, any technology company, right? Virtually in every other competitive space in our economy, skill is rewarded, it's appreciated, it's lauded. And, the one exception is in financial markets where, if you see a discrepancy in skill among certain market participants, people automatically assume foul play or what have you. So, I've done my best in my career to kind of counter that perception that there's unfair advantages that high frequency traders enjoy that other market participants don't enjoy. Those are very, very ill-founded, and it's a difficult misconception to dispel, just because the rules are so complicated. And, another thing that I've advocated for over the years is just a great simplification of the regulatory regime. I think part of the paranoia and all the conspiracy theories, have their origin in the fact that there's just too many rules for most people to understand. But what's gratifying for me is that I think the single biggest thing that has not helped the case of the high-frequency trading industry is that the majority of the firms that are in it are basically proprietary traders. So the only beneficiaries of what they do economically, the only direct beneficiaries are themselves. There's obviously a lot of indirect benefit in the sense that a tremendous amount of liquidity is being provided to the market, and trading costs have come way down as a result of this industry being in existence. And it's really the glue that holds a fragmented market together. Our market system is highly fragmented. That was by design. The regulators did that to foster competition and lower trading costs. But as a result, you have a very, very complex regulatory regime where trading happens on several dozen trading venues, both lit and dark. And, high frequency trading very much is the glue that holds that apparatus together. And so it's an important fixture in the market, but, it didn't really do much help to the cause of these trading firms that they're proprietary and trading their own capital and so forth. So, what's gratifying to me is that, our investors in our hedge fund, the ones that will get to benefit from the returns of our high frequency strategies include, pension funds, they include endowments. So in a very real sense, mom and pop are going to directly benefit if we're successful, but by virtue of having investments in our fund, assuming everything goes well, of course. I'm going to continue to make the case because I believe it very, very strongly that quantitative trading in general and high-frequency trading in particular provide a very, very valuable social service to the financial markets. But, the fact that our returns partially benefit ordinary mainstream investors, is just another nice attribute to have. And, the flip side of that is that this sort of strategy has not previously been on offer for asset management investors. Like I said, typically to the extent that high-frequency traders raised outside capital, it was venture capital, private equity capital, because, this sort of business is very intensive in CapEx and OpEx, and so you need permanent capital. And these firms are much more like technology firms than they are like hedge funds. And so we've changed things around a little bit, and we decided to capitalize our business using the asset management business model. And so for the first time, really, high quality, high frequency trading strategies capacity is available through a hedge fund business, which has been very interesting to investors. But there's all kinds of tangible benefits from doing so. It's a very capital efficient combination of strategies. It's also a very synergistic blend of strategies vis-a-vis exposure to market volatility. High frequency strategies tend to do very, very well in volatile market conditions, whereas those could be pretty challenging for more conventional, longer-term quantitative strategies. So, they have very different risk exposures, which makes them both very synergistic components to an overall portfolio. So there's a lot of different reasons why this business model is super interesting to people.
Can you speak to us a little bit about the strategies that you are running there at Manor Partners and some of the things that you're doing differently besides the obvious things which we've just spoken about, but some of the things you're doing different in regard to your strategies? I know you did an interview with Business Insider recently, and one of the things you really kind of emphasized throughout that interview was how you're making use of big data and the explosion of data and that sort of thing. I'd love to hear you talk a little more about that and how that's actually driving your strategies.
Yeah, sure. One of the major secular trends that's at play in quantitative investing right now, quantitative investing has been very, very popular. It's growing in popularity every year. There's more and more assets being committed to the space. But, the problem is that the strategies that quants run as a result have become very, very overcrowded. and that's reduced their performance. There's a certain natural maximum amount of capital that can be allocated to strategies like this. And so, the overcrowding in the space really presents some major challenges. And in my view, the reason the space has become overcrowded is because, quants by and large to this point have relied largely on the same kinds of data as each other. So even if your methodologies are a little bit different, your end results are very likely to be correlated to those of other people if you're using the same inputs as them, right? There's only so many ways to transform inputs into outputs. So if you have the same inputs and you're using quantitative techniques to generate outputs, chances are your outputs are going to be correlated as well. And so, one of the biggest ways to address this situation is by using non-traditional data. And there is a huge amount of non-traditional data being generated nowadays from a variety of different sources. So social media throws off, absolutely gargantuan amounts of data through the so-called Twitter fire hose and other places. E-commerce activity is a veritable fount of interesting information that can be mined for predictive signals and trends. There's satellite imagery, which is becoming increasingly popular. There's, the Internet of Things. There's, the world is now awash in sensors that produce information that can be analyzed for patterns. So, my point is that lots and lots of quantitative information, either explicitly quantitative or implicitly quantifiable, is available now that has not traditionally been used by quants. And so it's opening up more and more of the traditional process, the traditional decision-making process used by discretionary investors to quantitative analysis. And, this is part of the overall broader trend that we've seen in force for many decades now of increasing mechanization of investing. So, you see this, in a lot of different ways. You see this in terms of like outflows from actively managed mutual funds and inflows into passive mutual funds and ETFs. You see it in terms of outflows from actively managed hedge funds and inflows into, smart beta or quant. What all of these things, whether they're index-based products that are passive or whether they're active products that are based on trading algorithms, what they all have in common is that they are mechanical and they can be back-tested. And, time and time again, academic evidence, but also, empirical results have shown that managers that make their decisions in a discretionary way, in a non-reproducible way, are really just not worth the fees that they charge. And mechanical trading universe has its own spectrum. There's the ultra low fee side of things, which is basically largely focused on indexing and smart beta. And then there's also some of the highest fee hedge funds in the world, which are quantitative. And also some of the most successful in the world. By all accounts, the most successful hedge fund ever created was Renaissance Technologies, which is no longer even open to outside investors. Well, it is through one of their vehicles, but their original fund is now closed and is all proprietary and operated with employee capital. But while it was open to outside investors, it was charging exorbitant fees, but still well justified by its performance. So, I think that the fact is that investors have seen that if you're going to charge high fees, you need to be able to empirically show that you deserve them. And if not, then you need to charge very, very low fees, which again suggests a heavy degree of automation at a minimum, or just outright passive indexing. So either way, these are all manifestations of a long-standing secular trend towards greater and greater mechanization, automation of the investment process. And that trend, shows really no signs of abating. And the latest manifestation of that is that more and more, longer-term decisions, capital allocation decisions that are made by discretionary investors can instead be made by looking at patterns in non-traditional data. And so, not only do we have a absolutely staggering amount of data being generated from all of these different disciplines, but we also have simultaneous innovations going on in cloud computing and storage to basically use both elastic storage and elastic compute capabilities to analyze that data on demand and very, very cost effectively. And then simultaneously, we're seeing a renaissance in the space of artificial intelligence. Artificial intelligence has been around for a very long time. It keeps going through, various rebrandings. The latest rebranding is, of course, called machine learning or statistical learning. But there have been some really potent innovations that have been made in that space. So we have all the ingredients. We have the raw materials, which are the data. We have the analytical tools from statistical learning, and we have the hardware substrate to store and manipulate and access all of this data at low cost. So, to me, this presages a revolution and a new renaissance, if you will, in the quantitative trading world. I think we're going to see, a new generation of superstar firms that are born in this environment that make use of these non-traditional data types.
Now, it's clear you're very excited about this explosion of data. Do you think that more data means more signals, or when you have more data, are the signals kind of watered down? Like, is there just a lot more noise being introduced?
Well, statistical trading, quantitative trading is largely about noise. So you accept a certain amount of noise. You want to try to maximize across your entire portfolio. You want to try to maximize your signal to noise ratio, but you're very tolerant of noise. What's important is the orthogonality of the signal. How unique is it, or how different it is? Is it from the existing sources of data that you have? And that's really what the promise is of these alternative data sources, is that the signals that they generate are highly uncorrelated, or in other words, statistically orthogonal to signals that you can generate from more traditional sources. So that's roughly how you measure the value that data, new data can add to your investment paradigm.
Yeah, and when you're developing your strategies at Manor Partners, are these purely data-driven, or is there what's the right word? Are you sort of factoring in human behavior? Is there something more to it than just being purely data-driven?
They are definitely powered by data, but you can't eliminate humans from the equation. We're nowhere near, the state of the art is nowhere near that being a plausible reality. So, human beings still are the ones who describe the investment strategies. And really what it's about is automation. We are, at our firm, very highly seasoned investment practitioners. Collectively at our firm, we have over 200 years of quantitative trading background amongst our, 45 or so employees. And, we've got people here who are very, very seasoned and accomplished in a lot of different asset classes, whether it's fixed income, whether it's equities, domestically or internationally, or in emerging markets, or whether it's volatility, or futures, or what have you. We're very, very well covered on all these different asset classes, and so a lot of what we do is essentially attempt to automate the investment process of discretionary investors. So, automating the process comes with a lot of tangible benefits. Number one, it makes your investment process repeatable, but it also makes it backtestable. We can basically go back and see how our strategies would have done in historical market conditions, and in which conditions they did the best in, and how to ameliorate the performance in cases where they didn't do so well, and how to address the deficiencies. But ultimately, real changes in the prices of securities, permanent changes in the prices of securities are driven almost entirely by human beings that are making investment decisions. They control the vast majority of the capital in the world still. And so quants as a whole still don't control that much capital in the grand scheme of things. And more importantly, they invest for short timescales. So for example, a quant that's investing with a 1 week holding period, just by definition, they're buying exactly as many shares of every stock as they're selling over a 1 week period. And so over a 1 week period, their net market impact on a stock's price is precisely zero because they've taken the same number of shares out of the market as they put into the market. So during that week, their buying may have caused the price of the stock to go up, and their selling may have caused it to go down. But in the aggregate, when you look at the sum total of their activity in the aggregate over their holding period, it's zero. And so what that tells you is really very long-term investors are the ones that dictate where securities prices are heading. And so to the extent that you can attempt to understand how long-term investors reason about their capital allocation decisions and automate that decision process, to me, that represents a very fruitful approach. So although our strategies are driven by data, they have very strong structural priors, if you will, which allow us to harness the data in a very structured way. So that's particularly important when you're dealing with these new data types, because the fact that these data types are unstructured or very novel does not automatically make them conducive for statistical learning. Statistical learning or nonlinear methods in general require far more data to calibrate and to estimate than traditional linear models, which have been around forever. And so you need a lot more data. And, the thing about these new data sets that are coming out is they have very limited histories and very limited time series over which you can train these kinds of models. And so it becomes that much more important to have a strong structural belief system in place for how the market works, and to essentially use the data to strengthen or weaken your hypotheses about how the market works, rather than to use the data to build your entire model for you. I think that is a less fruitful approach, and it's also an overcrowded approach. I've made the point publicly before that there are a very large number of people out there with data science pedigrees, and data is universally available. And so you see a ton of people building models who don't actually know anything about how the markets work structurally. And so they all end up building the same thing, right? Again, it's the same set of inputs and the same set of methodologies. Obviously, they're bound to produce highly correlated outputs, right? Regardless of who's doing the analysis. Our approach is a little bit different. Our approach incorporates an awful lot of very sophisticated understanding of what kinds of strategies other people run and in what situations. And we basically use data to refine our models and to calibrate our models, much more so than to tell us how the market actually works.
Now, Manoj, I know you've got to run in a minute, so let me just ask you this one last question. What advice would you like to leave for aspiring quant traders?
Well, I think that there's an awful lot of people out there that I would view as very, very bright who, are very good at learning. They're very good at school. They've done very well at school. They come from top universities and have excelled there. And these are the sorts of people that quantitative trading firms hire, very, very skilled engineers and scientists and mathematicians from top universities. And success in quantitative trading or in investing in general essentially means being willing to buck the trend. It means doing things a little bit differently from how other people are doing them. If you're just trying to copycat, if you're trying to learn what other people are doing and just copy it, you're going to run into the fact that they've been doing it for longer than you and they understand it better than you and are entrenched and have economies of scale. And so it's very, very different. It's very difficult to kind of emulate a successful business case and study all these successful business cases and say, I want to start a company exactly like AQR, or I want to do what AQR is doing, or I want to do what D.E. Shaw is doing, or I want to do what Rentec is doing. To me, that's the greatest temptation that people have, but it's also the least likely to succeed. I think that you're likely to succeed, or much more likely to succeed, if you have original ideas, if you're willing to think out of the box, if you're willing to look where other people aren't looking. And, that does involve some amount of understanding how other people do things, but it also involves kind of like being able to think freely for yourself and not focusing so much on that. That would be my advice. Definitely learn about the space, learn about the techniques, etc. But don't try to copycat what other people are doing, because it's going to be very difficult, especially if they're very, very successful, for you to compete with them in their wheelhouse.
I really love that advice. That's awesome, Manoj. I just want to say thank you very much for coming on the podcast. I know it's been a little bit difficult to squeeze in, and we've been trying to set this up for a long time. So I'm really stoked we got the chance to do this. Where can listeners go to find out about you?
I don't know. Google. There's a lot about me out there.
What's Mana Partners' website? That might be a good place.
It's www.mana-partners.com. MANA-partners.com.
Manoj, once again, truly appreciate it, man. Thank you very much.
My pleasure.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers open the doors. Mobile apps made trade risk is capped. It's time to trade.
India's best platform for option trading tools, a pre-built strategy selector, risk analysis tool.
And risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Okay, how you doing, everybody? Here we are, episode 119, and first thing, I have a bit of an announcement for you. Last week I mentioned I'm heading to New York very soon, and I would have more details this week about a Chat with Traders event. So here it goes. On Tuesday evening, the 2nd of May, I'll be putting on Bears and Pizza and a live podcast. And following that, a Q&A session. The live podcast will be a casual interview with a trader. Who that trader is has not been finalized just yet, but I will keep you posted. The venue will be the event space at WeWork in New York's financial district. It's a really cool spot. The cost to come along is all of $12, and that covers absolutely everything. You can RSVP right now at chatwithtraders.com/NY. So if you're thinking about coming, please don't sleep on this, because there are limits on how many people we can have there. And I should also mention this event is made possible and dirt cheap thanks to two awesome sponsors, Trading Technologies and Sang Lucci. Once more, the link to reserve your spot is simply chatwithtraders.com/NY. I'm pumped for it. It's going to be a lot of fun. Now, I'm also excited for you to meet my guest this week, Alex. He's asked if I could keep his last name private, so I'll of course respect that. But to further identify him, his Twitter handle is at TAGR Alex is a 27-year-old day trader from Texas. He's been trading full-time for 4 years now and recently has really begun to hit his stride. Alex closed Q1 of 2017 with a $49,000 gain, after going into the year with an account balance of $32,000. He's a small cap momentum trader, but unlike most guests who have had on previously that play in this space, Alex takes the majority of his trades on the long side. So naturally, we chat about his reasons for this. We also chat about the leap into full-time trading, key lessons Alex learned in the early stages of his development, how he manages trades, and why journaling has been immensely helpful. That's it. Let's do this. Please welcome Alex to episode 119. Alex, how old were you when you first got interested in trading, and what were you doing at the time?
I was probably 19 or 20 years old. I was in college and I was waiting tables one summer when I was back at home. And I've always been kind of a saver. So I didn't have a lot of expenses. So I had some money saved up. My dad kind of near the end of the summer said, "Hey, why don't you put some of that money to good use or try to make some money with it in the market?" I thought, what's the worst that could happen? That sounds pretty good. And I opened up an E-Trade account, my first little brokerage account, and I put about $2,000 or $3,000 in there. And I remember him telling me that these agriculture stocks have just been going crazy, and everybody's making money in them. And I put a few bucks in there, and the rest was history. That was kind of my first little taste. But after that, I didn't trade for a couple of years.
So why was it that your dad kind of influenced you to take a shot at trading or more investing? Does he dabble in it himself?
Yeah, so he was actually retired at the time. He's one of those guys that always has CNBC on around the house. Jim Cramer, I grew up to him yelling, hearing that voice yell. So it was just kind of almost a natural thing. He was really big into business, and I was really interested in business, but I had no experience. When he brought it up, I thought, you know what? If he was the one recommending it, what's the worst thing that could happen?
Sure. You're young, you had some savings. Why not?
Exactly.
So you said that you had this kind of first run-in with trading or investing, I'm not sure what you'd call it, and then you didn't do anything for a couple of years. You came back to it. What sort of brought you back to it? And, tell us a little bit about that time.
Yeah, so the first, that little summer, I probably just traded about 4 different stocks, and I ended up having to go back to school that fall, and it wasn't even really in my thought process of being a trader. It was just kind of a thing. And I kept the account open and it had the money in there and I didn't touch it. And then after I graduated college, I got a job at a software company in Dallas, Texas. And after about 6 months of working there, I had kind of gotten the job, kind of figured it out. I was kind of coasting a bit. And I had some money saved up. From what I remember, I think I got a statement from E-Trade saying I had some money in there that I completely forgot about. And I thought, it's kind of the same thing I thought the time before. Cool. Maybe I can play around with this, almost more like a hobby. So when I was working full time, I put a few more $1,000 in there, had about $6,000 in my account. And at nights when work was slow and I didn't have much going on the next work day, I would do some research on Yahoo Finance and find some little garbage stocks that people were talking about, and I would place some trades while I was working. I really absolutely zero idea what I was doing. I don't think I even had charts up at the time, but as it seems like a lot of guys that you have on here, I just had some serious beginner's luck, and my first few trades were like 20 or 30% winners on about 3 trades. And that if that doesn't spark anybody's interest, I don't know what would.
And I know it wasn't too long after that, you actually had some real beginner's luck and you made something like $17,000 in one day. Can you tell us a bit about how that all went down? Yeah,
definitely. So I wish I wrote down notes about these trades in the beginning, but of course I didn't. I do, looking back on it, know I went 8 for 10 on my first trades were winners. And they were pretty substantially large because I was trading small cap stocks. And I eventually got a promotion in the first couple of years of that job, or first year of that job, stopped trading again because I was busy, and I picked it back up. And, I can't explain really what happened, but I know that it was going into a summer. And all these solar stocks were going crazy. The big ones like Elon Musk's Solar City and
Canadian Solar, and there was this small solar company that people on these message boards were saying, oh, it's $2, it's or $1.50, it's going to be $30. And it's kind of funny because some of my friends kind of think I'm like a hippie, or like, I don't know why they would say that, but I'm kind of more like an earthy guy. So I was all behind this solar thing. I thought it was just the greatest thing. It was going to change the world. So I took the money that I had built up, and I never took any of the money out originally that I had made while I was working. It was just kind of a savings thing, or almost a hobby, like I said. And I remember I put probably about half the account in there, and this little solar company, went to a meeting, and I came back, and that same day, about 2 hours later, I was up about $5,000. And I thought, what just happened? And so I'm sitting there, not looking at charts, just pressing the refresh button on my broker page. I ended up putting in the rest of the account in there, and then the next morning, I woke up. I didn't even know what pre-market trading was. I didn't even know you could do that. I was in a meeting, come out of the meeting in the morning, and I see I was up around $20,000. And like literally my hands were shaking. I was like, what do I do? Well, it's only $4 or $5 a share right now. It had already doubled, more than doubled, but these guys say it's going to 30. Let's just ride this train. I'd gotten up to around $25,000 to $27,000 in that second day. And I didn't know what to do. I mean, I literally was just kind of frozen, excited and scared, I guess you could say, because what happens next? Well, that same day it dropped about 25, 20, and then it hit 17. I just hit the sell button. And like any smart person, that's when I went home and talked to my wife about how I'm going to quit my job and get into trading full time. So that's kind of how it went for me.
Okay. Now, just before we get into that full time situation, why do you think that trade was beginner's luck? I mean, we had a chat before hopping on the call now, and you'd referenced it as beginner's luck. Why do you think it was beginner's luck?
Because I didn't know what entries were, what exits were. I was basically going off just based on people that were on message boards and listening to people and kind of following them, which I mean, I guess this could be a strategy, depending on what you want to say. But I didn't go into it with a plan. I did not see it happening, and it just happened. But I kind of thought because my first few trades were successful, that I mean, if I went 8 for 10 and I didn't know what I was doing, well, if I knew what I was doing, oh my gosh, how much money could I make? I mean, I was already thinking millions, but I had no plan. I had no idea what I was doing. I thought I knew what I might be doing, but I didn't realize it was beginner's luck at the time. It was 2 weeks later that I realized it was beginner's luck.
Yeah. And I liked your comments around the fact that what happened was just totally unexpected. Like you didn't expect to have any idea that you would make that much money off that trade. It kind of reminds me, I think probably a couple years after I got into trading, I was short an Australian mining stock here, and I'd been short the stock for probably about 3 weeks. And then one morning when the market opened, the price was down like 30%. And obviously a great day to be short, and it just kept moving. It was down 40% like an hour later, and I think it even got maybe down 50%. I don't remember the exact numbers, but it was severe. And I was just like, obviously I was in a short trade. I wanted to be short, but I was like, what do I do? Like I'd never traded through an event like that. You're just kind of like, do I get out now or do I try and like make the most of it? It's until you sort of like experience that event, it's really hard to know what you're going to do in that situation. Like you just don't anticipate for it, generally.
Right. You're frozen. I mean, I thought I was going to be in that trade for months, weeks, years. And then the next day I'm up more than, that number when I saw it in my account, it didn't seem real and I didn't know how to react to it. So
yeah. So tell us about your thought process when you went home that evening, had a conversation with your wife about quitting your job, going full-time into trading. How did that play out?
Yeah. So, I mean, at the time I was probably 24, 25. I had saved a little nest egg, I guess you could say, for as few years as I'd been working. And my wife at the time, she was a nanny. So she had a job and we didn't have a lot of expenses. And I just remember talking to her saying, like, what's the worst thing that could happen? I mean, obviously there are terrible things that could happen, but at the time it was like, I just thought that I didn't see the downside. It was, look, we're going to be just very wealthy here quickly because I'm going to quit my job and just keep doing this. It's going to be $25,000 after $25,000. So I think I not sold her, but I convinced her pretty easily that it was worth a shot. I was just worth a shot is kind of how I looked at it. It was selling my parents and my in-laws that was a little bit more difficult, but they all came around after I gave a legitimate backing or reasoning for it.
Okay. And how did you go once you went full time? I presume that you didn't, you weren't making 25 grand each day. How did it actually go?
Yeah, I would say day 3, I realized it was all beginner's luck. Basically how it went was I put my 2 weeks notice in with my company that I was working with. And at night I was just destroying trading books, just reading them so quickly. The one saving grace was that I created a business plan, which was a plan created for like a trend trader or a longer term trader. But it saved me early on. But my first 3 trades were losers doing exactly what I did before. I would say there were probably around $1,000 loss each. And I just remember sitting in my chair going, what the hell did I get myself into? I just left a really good job with a software company. And I thought I had this figured out. And very quickly did I realize I had no idea what I was doing. I barely knew what candlestick charting was. I didn't really know anything. So it was a very quick reality check that I had.
But you stuck to it, right? Like you didn't go back to your job. You've been full-time ever since that moment, correct?
Right. Yeah, exactly. So I would say on probably about day 3 of that, I did what any rational person would do, and I went to Google and searched, how to make money in stocks or small caps or something like that. I don't remember what I searched, but I remember that day, about the 3rd day, just being like, I've got to figure this out. And I guess some people I've heard just say you've got to like burn the bridge and just go for it. Well, I knew I had the job that I left there. I wouldn't say there, but I could probably go back to it if I wanted to. So I wasn't like really, really scared, but I knew I had to make some changes. And, I ended up signing up for like 2 or 3 chat rooms, some alert services, bought some DVDs. I dropped probably about $2,000 or $3,000 that day on just education. Unfortunately, a lot of that sent me down a really bad rabbit hole of learning really bad habits of averaging down on trades that shouldn't be and things like that. But no, I didn't give up. I dug in and I fought for 2 years pretty unsuccessfully. The first 6 months, as a matter of fact, I didn't have a green month, and that was very hard emotionally on myself. But ironically, after that first 6 months, every single month since then has been green. Not huge by any means, but I guess that says something.
Yeah, it's all about that consistency.
Right.
Okay, so how did you support yourself for those, especially those first 6 months? Like, was it just the fact that you had a bit of a savings nest egg that you could rely on?
Yeah, so I ended up building that first account that I started when I was in college to right around $50,000 through my winnings of my first 10 or so trades and that big one. And so what I actually did is took a little bit out as kind of what I would live on. We had some nice savings, and then my wife was working, so we had at least one check coming in, and we basically cut back as in, some people start businesses and they say like bootstrapping, like cutting your expenses down, trying to do everything as little as you can. Well, that's really kind of what saved me in the years where there just wasn't a lot coming in. What saved us was we weren't out living lavish lifestyles. And when I did hit a big win or a big trade, it's not like we would go out and have a steak and champagne dinner. That money was going like, either to help us, push forward a little bit or to go into the account to try to work with. So, it was a lot of grinding. It was really trying to every win, trying to work off that, knowing that I was going to have some losses ahead of me. It was a real battle with a lot of times my back was against the wall to the point where I did have a dollar figure that I had discussed with my family and my wife that if we got to that point, we would just shut down and I would try to move on from it. But, knock on wood or whatever, as close as I got there, we never got there.
Now, you brought up rabbit holes before, and if I understand correctly, there was a time, I presume it was after you went full-time into trading, that you began to vary from trading stocks like you had been doing initially, and you began trading things like crude oil, trading options, and that sort of thing. Can you tell us a bit about, like, why did you decide to, look to these other products that you could trade, and how did that go for you?
Yeah, so I would say simply the reason I did, I really tried to go out there and I guess test the waters and everything was, I saw guys online that were just consistently day after day putting up great numbers. And I had like one little thing I could trade in the small cap sector. And when that wasn't there, I was either losing money, over trading, or trying to test a new crossover, entry signal, or always trying to figure out what can I do to be more consistent. Well, just being new, I just thought maybe that meant trading options, or that meant adding futures into the mix. But those, I realized, it's a whole different ball game when you get into those kinds of things. It's not the same at all. And that was actually probably what set me back in my growth was, but at the same time, the lessons that I learned in trading trying to learn how to trade options and trying to trade futures, help me now. So I can't really hate those periods, but I did but I did spend a lot of time trying to learn things that were just not set up for my personality. And I also, even with shorting, I tried to learn how to focus on shorting, but it just didn't match my risk profile. I do not like taking large risks. I don't like large drawdowns and things like that. So for me, I guess it was a learning experience of what not to do.
I like how you talk about that sort of exploration phase as though it wasn't a waste of time. It's kind of tricky because it's kind of like one of those things that you should maybe try and avoid, but when you do it, it is beneficial in some ways as well by sort of testing the waters and sort of seeing what other options are out there. So yeah, it's a tricky one.
100%. And even when I talk about it sometime and one of the main people I talk about trading with is my wife, because we share a lot of things together, and I'll laugh and say, man, I cannot believe I wasted, 3 weeks reading all of these futures books on like volume profile or auction market theory. And it got me nowhere. I'm not even using it anymore, but in reality, I am still using it, just in a whole different context. So yeah, it's hard to see it right away, but all those things kind of like build up your playbook or your strategy elsewhere.
Totally. So reflecting back on this time, do you think the way that you went full-time was a good move in hindsight, or do you think that you could have done it better?
Oh yeah, I could have totally done it better. But would I have done it? I don't know. If I knew that if I didn't know what I didn't know, and I think if I knew how little I knew, I wouldn't have done it. But because I kind of made that leap, I gave myself one bullet in the chamber, and I said I got one shot. I really dug in, and that probably pushed me harder than I could have ever imagined. I always laugh, like, would I want my friends to get into do what I'm doing, or my kids at some point? No, it's a hard business, and unless you really, really want to make it or really want to do it, it's hard. So I don't know if I would have done it if I didn't make that jump the way I did. Was it the right way? Probably not, but
well, it's worked out. It's worked out. So, Alex, I'd like to spend a little bit of time talking with you about some of the lessons that have been most effective sort of over these few years to get you to the point of where you're at now. One of the things which I think is quite cool about your story is that you have been able to avoid blowing up any trading accounts. I speak with a lot of traders, I'm sure you do also. And it's very common to hear that new traders will blow up their account multiple times. You have been able to avoid doing that. Why do you think that is?
First off, it was because for some reason the way I began my trading was kind of like building a model based around long-term trading. So like risking 2% of your portfolio per trade. And I kind of hammered that into myself early. Not that I mean, sometimes I took larger percentage, but really not like detrimental losses. And, you know, like you said, you've seen people, I've seen people, I've made a lot of friends in trading, and I probably still maybe talk to one person because a lot of people have blown up. And I'm not saying that shorting is bad. I know a lot of people that do they do very well for themselves shorting, but a lot of starters, a lot of people that don't know what to do really put themselves in some bad situations early on. And even with leverage in itself, just margin. A lot of people try to get on margin to put up big wins early on. And I never once traded on margin, and not because I can't say I'm smarter or like, man, that was a great call by me. I just didn't think it was, it wasn't right for me. I like to sleep at night and I like to enjoy my life outside of trading. And those things at the time just were not there. So I kind of avoided some of the really big pitfalls that some people go after. I mean, I was okay with smaller wins early on versus trying to go for the big ones. But like I said, I saw guys that would come in and I talked to them for 2 or 3 months, and then they'd be short natural gas 3 times levered ETF, and they'd be so far underwater, they'd be adding to it. And then I just never hear from them again. And I feel like that happened so many times. So was I lucky? Probably, but I would say I kind of stacked those really big landmines. I didn't put those in, I didn't have those around me.
And I think that's a really important point. Like when you're just getting into trading, you shouldn't really be trying to take home those big wins. Your priority should really just be about trying to make good trades and get some consistency with those. Once you achieve that, then you can think about scaling up and trading some size. But until you can actually get to a point where you're taking good trades and you have consistency, you're just setting yourself up to fail.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So even though you haven't blown up any trading accounts, have there been any costly mistakes during this time? Like, can you reflect on a really costly trading mistake if there have been any?
Oh, geez, I can name a lot of them. And yeah, I mean, all throughout my first 2 years, it would be my profit curve or whatever you wanted to look at it was filled with big spikes and big drops and big spikes and big drops. And luckily none of them were detrimental, but I would say probably the worst thing for me as a long bias trader, and I do short every once in a while, but it's typically intraday. But for me was averaging down was probably my big weakness, and still kind of is, because unfortunately when I was new, I got involved with some of the guys that do a lot of the really good marketing, and they have really big followings, and they'll send out alerts and they'll spike these stocks massively. And when they're wrong, they'll average down on them and spike them up a little bit more, and average down and spike them up, and they'll eventually get out. But that doesn't work for you and I, or the average guy that don't have 1,000 people following our trades. If you average down on a bad trade, you're just putting yourself just digging yourself into a huge hole. And I did that a couple of times where I would average down and I'd say, okay, well, this is gonna get me back to even when it pops, and when it doesn't, then you're just multiplying this trade that's just going against you, and your emotions get involved. And kind of like whenever I was up $25,000 on that trade, and I didn't know what to do. You're just sitting there and you're just paralyzed. You're looking at the screen, but you're like almost like you're blacked out, like you're not seeing things correctly. And that's been, my biggest thing that has hurt me is averaging down into trades, and quite frankly, cutting that out and just saying, all right, just zero, none of that. Absolutely helped me, but it took about a year to figure out that was actually not a good strategy.
What things have been most beneficial to your development? Like, I know you've read a lot of books. You were talking about that earlier. You said you've read a lot of books on trading. So has it been a matter of reading? Has it been, content online? Has it been getting good education? Has it been screen time? Has it sort of been coming up with your own observations? Like, what things have been most beneficial to you as a developing trader?
All the above. Everything you just said, screen time, books. I mean, just putting all the pieces together. I mean, I don't want to say that like all the chat rooms or all the early things that were bad. I'm still in a couple of them where there's some guys that are really good, and watching somebody, execute trades and talk through it that's actually knowledgeable is just, I mean, there is just nothing more useful from that than getting a perspective and getting in somebody's head who's really, really good, kind of like a digital age mentorship. But unfortunately, there's a lot of them that aren't good, but the ones that are good are really helpful. And then books, like things that aren't even, necessarily, I think, all the new guys want to know about, like, oh, how did you see that signal, and how did you get in? Or it's like, how'd you get in, and how'd you get in? How'd you get in? But nobody really cares about like, how did you manage the trade, or, how did you control your emotions, and I like to say, like, how did you trade flawlessly, like without error? I mean, it's not always going to work perfectly, but as long as you trade flawlessly, that's what really matters. And that came from reading, old school trading books. God, my mind's going blank right now, but I have lots of them that I've read. And then screen time. Yeah. I mean, even if I was like losing money and it was hard and it was just rough, it was just waking yourself up in the morning and just watching the tape and just putting all the tiny little pieces together. So it's hard to say what was most helpful, but I would say if any of that would be just like tracking progress. I wish I did that earlier, and tracking trades and being able to see what works and what doesn't, because, you can read 80 books, but what works for you, or you can watch, 100 trades, but what works for you is completely different. Than that's what really matters.
And do you think that there was a turning point for you, or do you think it's just been kind of accumulation of things you've learned, and more of a process more than a definitive turning point? Because, you said your first 6 months, you had every month you were in the red, and then after that, things kind of turned around. Was there anything you can put your finger on that happened during that time?
Yeah. So I guess the turning point for me was knowing that, ironically, those first 10 trades that or whatever trades that I did before I went full time, they were all based around a method that I didn't even realize I was doing. It was basically like trading sympathy plays or sector rotations or something like that. Like, you're getting in a hot sector and your probabilities just go up infinitely. It's just you have a bid behind your trades, and you have a really good chance of your trades working. Unfortunately, what I would do for the first 2 years is I would get in these sectors, I'd make a lot of really good money, and then for the next like 3 months or 2 months until a really hot sector came in, I would just throw money away, essentially trying to learn options or futures or even trade a different strategy. But when I could really sit down and look at the numbers, and I could say, wow, man, in like a 2-week period, you made enough money to where you were fine losing for the next, 6 weeks. So why don't you just do that? I know it sounds silly to be like, well, how did you not realize that? But it comes back to tracking and journaling and things like that. But it's, doing that and then expanding to doing more of that and then finding things that work for me and things that don't work, just cutting that out. And, honestly, some of the guys on your podcast, like, FT71, like learning about like probabilities, things like that. And even, Tom, I'm going to butcher it, Dante or Dante, about like journaling and tracking and things like that. I mean, those were huge turning points because I was making money, but I was losing it. And it was just about how to lose less and make more. And it sounds so simple, but that was big,
Yeah. I mean, it does sound simple, but unless you're actually measuring your performance and you're actually tracking your trades and that sort of thing, it's very easy to forget about what sort of things went wrong 2 weeks ago. Those trades are forgotten about by now. And
yes, like them staring them in your face. I mean, once they stare in your face and they don't go away, it's really hard to forget about them, but it's easy to forget about them if you just don't track them.
Absolutely. And we're going to spend a little bit of time on journaling. But before we do, let's talk a bit about how you're actually trading these days. So what sort of trader are you? How would you describe your methods in that?
Yeah, I mean, I am trying to evolve constantly and learn new things. But I would say right now, what works for me is consider it cash flow trading, intraday cash flow trading. So looking for really good opportunities each and every day, typically in the small cap sector, because it's kind of what I'm comfortable with. It's what I've always done well. But looking for specific setups, specific times of day, and specific industries based on kind of what's hot. And it's not like I'm going for home runs. I don't wake up in the morning and say, today's the day, I'm going to hit it out of the park. It's going to be awesome. But it's like, all right, we're going to come in. I have a plan with maybe 3 or 4 stocks that are in play, higher than average volume for their style. And yes, they're garbage. Yes, more than likely they're going to do an offering at some point, but I'm not in it for the long term. I'm just trying to hit certain points. And if it's 1 or 2 or 3 or 4 trades a day, I go for really high probability. So I know some guys, they thrive off maybe getting 30 or 40% of their trades correct, but hitting big home runs. I just go for the 70, 80% correct, taking my money, washing my hands, walking away, and coming back and looking for the next one.
Okay. So what you mentioned, cash flow. You're trading like cash flow. Can you just elaborate on that a little more?
Yeah. So right now, because again, I'm still newish. I mean, it's been almost 4 years coming up June, but I'm still learning a lot. So what I'm trying to do is basically build up a war chest so I can try different strategies, more maybe trend following or swing trading or going for bigger wins. But right now, what I'm really just trying to do is build up my account, getting that screen time and getting comfortable with certain setups. Because as I'm sure your other guests and other people know, I mean, a setup that works on the 1 minute, let's say a 1 minute chart flag works on a 5 minute chart flag, works on an hour, daily, weekly, monthly. But I'm trying to get those 1s and 5s and 10s and 15 minute trade setups so I can start putting more money in these longer term plays. But, I'm trying to build it daily essentially.
Now, I follow you on Twitter and I saw you post something just the other day and you referenced a trade as a grade A setup. Would you mind talking to us about what is a grade A setup?
Yeah. So for me, a grade A setup is and it's funny because I know you talked to another Alex, who's heavily on the short side, and he was talking about that big dry short that he had. And for me, the grade A setup, why that's his grade A setup shorting that, my grade A setup is being on the other side of that, going long that sector. So when that stock went from 1 to 115, I wasn't necessarily trading that stock because it had a lot of potential to be halted by the SEC and, whatnot. But for me, a grade A setup is when something like that's just going bananas. And the other stocks in that sector have a really good chance of going with it. Not 100%, nothing's 100%, but those stocks in that sector that are similar size, float, things like that, if a good setup comes in there, it's a really good chance it's going to go. So, you have your 3 or 4 other stocks in that sector, you're watching them. The leader stock gets a big push of volume. The other guys get a big push of volume, and you're watching this flag pattern or this consolidation setup. And for me, it's kind of like a big green light saying, all right, it's go time. Then you execute your trade however you want to, your way. I'm more of a scale in and scale out kind of guy. So I like to, before I think there's going to be a breakout, I'll start a position. End of the breakout, I start a position. And as soon as we break out, I'm already taking profit because, again, I'm a cash flow guy. I'm not trying to get 150%. I'm just trying to make my money on that trade, use it, build up so I can put a bigger trade on for the similar style in the next one. Okay.
So, Alex, if I was to ask you, what is your edge? How would you respond?
My edge now would be I've been able to identify what I'm really confident in and where I can control my emotions. And so I used to put on a trade and I would be so full of emotions that I wouldn't trade it, put the trade on well, I guess you'd say. I would, stop out or sell too quickly. But now I've really gotten my emotions controlled that I can look at a chart and see it objectively. And so when I'm wrong, I'm wrong. When I'm right. And for me, that just kind of like, it changed things for me when you could see clearly without emotion, that you can make just correct decisions as simply as that. It's not anything, sexy. Like my edge is this like algorithm that I've built that tells me when to get in and get out. It's just, I know I can trust myself. I know when I should get out. I know when I should get in, and I don't take massive losses.
I think that's good. And I think a good question that I should ask you, especially because when I think about some of the people who I've had on this podcast previously who are trading small caps and they're trading them intraday, most of them seem to have a tendency to be short on their trades, to favor the short side. You're much the opposite. Like you mentioned a little earlier, most of your trades are on the long side. Why do you think that is? Why do you tend to favor the long side more so than the short?
Yeah, so I've given it a shot. I mean, I've tried to short, and quite frankly, it just has to do with who I am as a person and my risk tolerance. I can try to short all day long, and I can know the theory behind it and how it works, but knowing that black swan event could be around the corner, and that I could go from having, let's say, 11 great years of trading, and then that on that 12th year I make one slip up and I'm potentially negative equity in my account. That just doesn't settle well with me. And I'm not saying it's not smart. I'm not saying people shouldn't do it. I'm just saying it doesn't work for me. And it took me a long time to realize that it's just, I kept trying it. I kept trying it. But I had to realize that I'm just not comfortable. Going with my edge is not having emotion. I'm just filled with emotion when I'm on the short side, because I'm just always in the back of my mind that it could really hurt. Even if it's a small size, it could really hurt. And I could work on it. I can spend a lot of time working on it, but I'd rather not.
Yeah. So when you talk about, you're trying to avoid the black swans when you're shorting, what do you mean by that? Are you talking about because when you're short in a position that there's pretty much unlimited downside because the price can run as high as it likes?
Right. And especially when you're trading small caps. Maybe if you're trading things like Apple and you're short, it's not likely going to go up 1,000% on you. But on some of these small cap ones that are trading at, $1.50, let's say, for example, it's not crazy to see them go to 8 in a flash, and that's really hard to control risk. Not saying that you can't control risk. You definitely can. But for me, it's like, what if you just came to work tired that day, or you just forgot to put in a stop, or or just something happened, your computer turns off, and then next thing you know, you're in over your head. That's just always in the back of my mind.
Yeah. And you mentioned Alex, who I'd had on, I think it was episode 104, who obviously favors the short side very much. He actually spoke about that as well. And that was one of the things he kind of admitted was sometimes frightening about being a predominantly short seller. So, I'd encourage anyone to listen to that interview as well, chatwithtraders.com/104. Let's talk a little bit about how you do manage risk. So talk to us about how you actually manage a trade once it's on, and how, let's talk about that first, and then we'll talk about position sizing. So how do you manage your trades?
Yeah, so basically I used to trade off things like scanners, or honestly, that sounds bad, but people's alerts on stocks that I didn't really know what they were or really anything about them. But now that I've gotten comfortable with myself, I know what I like. I come in with about 3 or 4 stocks that I'm looking to trade that day, and I know the exact levels where it's just that trade is done. And so one of the things that I used to do when I started, and a lot of people do, I see either on Twitter or in different chat rooms, things like that, is they say, okay, I'm going to risk $250 on this trade. I'm going to put my stop at that mark where it's $250. But they don't pay attention to that the market doesn't care where that stop is. Your stop might be right on top, right near support, and it's going to test that, take it, and go. But what I do is I set levels where I know, and this I learned from FT71 from your podcast and just following other ways, is you set your stop where the trade is just no longer. For me, it's like if I'm going long, when the stock goes low of day and it breaks the low of day, I'm out. Like, just no questions asked, I'm out. So if I'm willing to risk, let's say $300 on a trade, I say if it goes that low of day and it's at $300, it's just I'm out. It doesn't matter what you couldn't sit there and say no, you need to do it. It's smart. No, I'm out. And it's really as simple as that.
Okay, and how do you manage your position size, or how do you think about position sizing? And just to take that one step further, how has this changed over the course of your time trading?
Okay. Yeah. So over the course of the time, I don't think I really managed it in the beginning. It was kind of like I would do like what I saw other people doing almost, or, it would go off, I guess, a gut instinct, like, oh, this sounds good. I'm going to put a quarter of my account in or half of my account. Now I have, based off, tracking my trades, I have trades that I'm very comfortable with and trades that I'm working on getting comfortable with. The ones that I'm very comfortable with, I'm okay with putting about 30% of my account in a trade in. And again, it's not an exact science, or not again, it's just not an exact science for me. Maybe it should be, maybe that could be something I could work on. But as my account grows, I just take it a little bit slightly larger positions. Yeah, I wish I had a better answer. It's not really science for me yet. I think that's a part of my plan going forward. But really, for me, it's about managing that risk, like knowing where I'm going to stop out. And as far as position sizing, I like to scale into trades. So if I'm looking for a breakout, take a little bit of a starter position, and I don't go full size into that breakout level just in case it fails and I'm at a big loss. But it would be just building into that breakout and then selling into that breakout.
Okay. So how many times are you likely to scale into a trade? I guess it probably depends on how far the move runs, but yeah, can you give us a bit of an idea around that?
Yeah, I would say probably maximum like 3 times the scale in. So I usually have like a little starter, and the reason for that is, if I'm completely wrong, then it's not going to hurt me very much. It's going to be a very, very small loss. And then as we progressively get closer to this area that I'm looking at, maybe I'll take one more before we get there. And then I like to basically hit like on that spot, because if I'm right, then it's a quick little push and I can take a little bit off. And if I'm wrong and it pulls back, like it's quick. I know it's not going to go, and I'm okay with that. And then at that point, I've already got a little bit of profit buffer. And so I can either take it all off or scale out. But typically if something that I'm looking for, if I'm looking for a breakout and it doesn't break out, I'll just take my position off. And it's not like I'm done with that trade, but usually right now, because again, I'm really going for consistency. I'm really trying to go home green every day. It's, if it didn't work, maybe I'm missing something. I just move on.
Have you ever run into any challenges with scaling? Because when you scale, it's, you can end up giving back some of your gains on as you take your second scale, you can, if that doesn't work out, you can end up giving back gains that you've made on that entire trade, or maybe not an entire trade, but a good portion of them. Have you ever run into any challenges that are somewhat similar to that sort of scenario?
Oh yeah, totally. And that's actually one of the things I came into 2017 working on, is that I let a lot of my scales, my adds kind of hurt me, because I would be in a really good position and then I'd add right into either a wall or it would just come right back. And then that last add was what either turned a winning trade into a loser. So that is painful. And then the really painful thing, and it's just something that you see a lot of guys on Twitter and just talk about in general, is, letting your winners run and stopping on your losers fast. Well, it's for me as a guy mentally who was fighting with my back against the wall for years. And when I could take it, when I could get a win, I wanted to take it. And it's the hardest thing is whenever you're scaling into a trade and you've got some green, to try to let something that's already winning run, knowing that very, very well it could come back and stop out. And you're looking at this, unrealized, let's just say, $200 or $300 gain, and it just evaporates and you had it. And it was in your hands, but you just let it go. And that's so hard. It's so hard. But then you also can see the times that, oh my God, it could have run another 50, the kind of trading that I focus on, which is very volatile, small cap, it can go another 50, 100%. I mean, you don't know. You just don't know. And that's right there with probably one of the hardest parts about trading, is just, you obviously don't know. And it's something that is actually, I think I wrote it on Twitter this week. That was my number one goal, was to leave my runners on. And what do you know? All my runners this week on have been stopped out, because obviously the S&P is going down. I mean, the trades aren't following through, but you got to do it. I mean, it's a part of the game.
Yeah. And with your scales, are they equal position size, or is each scale slightly smaller? How do you work that part?
Yeah. So typically my first start is my smallest. And this kind of also goes with is it an A setup, a B setup, or a C setup? If it's maybe a C, maybe I just consistently keep adding small ones. Let's just throw out a number, just for example, like 1,000 shares, and then 1,000 shares in the breakout. But if it's something I'm really comfortable with, like we're talking about that sector when the shippers were going crazy, starting off with maybe 1,000 shares, and the next one's 2,000. And then heck, if I'm really feeling like this is the stars are lining up, 5,000 or 10,000 shares into that, and then quickly scaling out, like taking that risk off as soon as it works, because I don't want that major exposure. But I go, this is gonna work, and it sucks when it doesn't, but when it does, it's awesome. So it really goes along with, and I know you said you're going to talk about journaling and tracking later, but it goes with, where's my confidence? I know where my confidence is, and I'm willing to put on more size where I'm really confident. When I'm not, I'm just going to keep it small and, just take those little wins and move on.
Well, let's get into that now. Let's talk a bit about your journaling and how you manage all of that. So how do you use your trading journal, and what sort of things are you focused on? Yeah,
so I would say it's like my most important tool. I spend probably, I don't know, a few $100 a month, maybe probably $1,000 a month on different scanners and charting platforms and all that stuff. But I think it's Microsoft OneNote trading journal, and then my Excel spreadsheet and Edgewonk I spend almost nothing on, but I get the most value out of them. But I didn't do it in the beginning. I actually had it set up and I just didn't log it, because in my opinion, I didn't know what to look for. I didn't know what was I looking for in these spreadsheets. But now all I do is at the end of the day, I just log all my trades, no matter what, winners, losers. If it was a flat trade, I still log it. And it's very time consuming, especially when you do scaling trading like I do, because you've got to put in all your scales, all your scale outs, notes on all the scales. But how I use it is on my Microsoft OneNote. I have a different log for each day, and I just simply write out notes for the day. Like when I wake up in the morning, and it sounds silly, but I'm like, got a good night of sleep. I'm feeling rested. I'm feeling ready. Maybe today we can put on a little bit more risk. I'm looking at these sectors, and I'm just kind of like talking to myself really, and then writing it down. And then throughout the day, I'll just put simple notes of like, just things that I notice, like, hey, this stock's getting some interesting volume while these other ones are. And it's really just a log of what I'm talking to myself, basically, because I work from home. I work by myself. I don't have coworkers and like that. So it's kind of how I do it. And then at the end of the day, I put how much profit I made that day, and then like a couple, like what I did well and what I could work on. And that's it. That's it. And then I just keep them all. And then in I use Edgewonk for tracking my trades. I put some very detailed information in there, and it's really helped me, just immensely helped me, putting detailed information such as time of day that the trades happen. That's been a huge one for me. Figuring out what time of day is there's some times of days that I just shouldn't be trading, and I found that. The setup, why I got in, why I got out, how my emotions were, a rating between 1 and 5 of my confidence level on that trade. Geez, I probably like 4 or 5 other more columns on just each individual trade, because after you get 100 trades in there and you can start filtering through different things, you start noticing things like really quickly. For example, I noticed very quickly that I usually start the day off with a losing trade. In the first 15 minutes of the day, 8 times out of 10, I would start off with a losing trade, and then I'd be fighting to get back to green. And so very easily I identified that. And I said, okay, you've got to sit on your hands and pass that first trade up and let the market cool off a bit. And then you go, and then you start attacking your trades. And I mean, it's just so much, it just feels so much better to come at it that way. And then also noting which of my trades have the most confidence level. Like you were saying, how do you scale into trades? Well, if I see a certain setup that I know my confidence level is high on these specific setups, those are the ones I'm willing to put more risk on. The ones that are maybe like a 1, 2, or 3, they're still profitable. I still make money on them on the long run, but it's just not ones that I'm really willing to put a lot of risk on. And that's the kind of things I've been able to notice.
Yeah, and it was really funny to see, or not funny, it was really cool to see this chart that you shared, and it showed the growth of your account, and then you had a big red arrow pointing to where you actually started to journal your trades, and the way that the account grew from that point on was quite a bit quicker. So that was very cool. And guys, I'll just mention, actually, as you brought it up, Alex, I'm an affiliate for Edgewonk as well. So if you guys want to check that out, it's edgewonk.com. And if you use the coupon code TRADERS, you'll actually get $20 off. So well worth a look. Moving forward from this point, Alex, what are some of the things you are really trying to focus on? What are some of the things you're trying to improve or achieve?
Oh, there's a lot. So my I guess you consider my playbook right now is rather small. The things that I'm really comfortable with are I have like 3 or 4 different setups that I come to the market with every day, and I try to expand on, or try to make money in those. And I really want to expand that slowly and at a low risk pace. So again, going back to one of my biggest problems that I have personally is that I see guys putting up just massive numbers all the time. I mean, I do well for myself, but guys that are doing like 20 or 30 times better every single day. And there's guys that aren't legitimate, and there's guys that are. But seeing those guys, they just have such a wide net of things that they can look for. Different styles of trading when the market's down, up, sideways, when different things are going. And I would really like to expand on that, because I have a couple of things that I look for, and I can usually find like 1 or 2 trades a day. And don't get me wrong, it's great. But to really take it to the next level, I'm looking to add more of those. And then scaling up my trading. For the longest time, I was just trying to be consistent. I just wanted to make money every day, and that's all I wanted. And even if it was $100, just to go home every day with that. Really trying to as my account grows, slowly size up in my trades. Not like anything drastic, like all of a sudden I start putting on margin. I still have never traded with margin, and maybe I will, but really trying to scale up. And I would love to start looking into some more longer term strategies, trend following, or position trading or swing trading, because I do 0 of that right now. And I know it works, and I know people can do it. It just has not been a priority of mine. My priority has just been get my back off the wall, get some consistency. And now that I've done that, I'm trying to shift gears, to growing now.
Yeah, that's cool, man. I like the way you think. So you're trying to do a lot more, like different strategies, that you're trying to do more things which I think is really great. Is there anything you're trying to do less of?
Well, I've after going through my journal, again, no, not to keep harping on this, but it's just how I find things. I noticed that because I trade stocks under $10 typically, that also falls underneath the $1 mark. So I guess you'd call them penny stocks. I'm just garbage at trading those. And for some reason, I just keep trying and I keep trying. It would be great to just completely cut that out. And I know I should, but it's like, as soon as I cut it out, I have like you have that one good trade. And I think that's kind of a lot of people's problem is that they know they should be doing something and they get a little taste of something good and it's doing less of that. I'm trying to think, what else? I mean, I'm sure if you were to ask me and I could really think about it, there'd be just a ton of things to be doing less of. But I guess what I'm trying to do more of good things right now. So I'm just trying to increase those, the bad things. Hopefully those will dwindle out as I do more of the right things.
Yeah. Well, I think that's a really interesting observation that you've been able to pick up from your journal is that, stocks in different sort of price groups, you perform considerably different in. That's quite interesting. It's something I'd not really thought about before. So yeah, that's cool. That's cool to hear that. Just to take us out, Alex, are there any suggestions you'd like to share for traders who feel kind of stuck right now, who are still trying to find some traction? Is there any final words you'd like to leave us with?
Yeah, I would say, everybody goes at their own pace. Everybody does things the way they want. I personally trade a certain style, which is low risk. Some people would probably think that's absolutely boring. They would hate it. It worked for me. There are guys that trade, super high risk and it works for them. And I have nothing against that, but it really comes down to like figuring out what you're good at, like or not necessarily what you're good at, but like, what are you comfortable doing? What do you want to do? Just because you see guys killing it, trading futures or options, it doesn't mean that that's going to fit your personality. It doesn't mean that's going to be what's going to make you thrive. You've got to really look at what's going to be for you. Do you want to be a high percentage trader? Do you want to trade 70-80% of the time, be winners, or are you cool with being 30% and just sitting back and just watching your trades work for weeks at a time while you're relaxing? Because that's cool. I mean, like that, go for it. But it really matters about what you want to do because you can't fit somebody else's mold. And I tried that for so many years. I see so many people that do that on a daily basis, and it's just figure out what works for you and grind, man. I mean, just make it work if you want it to work, but don't put those landmines around you by just putting leverage on early, trying to go for too much. Just make it happen.
Great advice, man. Very good. Alex, I know you keep a pretty low-key profile online. You are on Twitter, though. Do you want to share your Twitter handle?
Yeah, so recently got into it. My wife pushed me out there to try to get me to talk to some people and get involved. But it's just at TAGR Trades, so Tagger Trades.
Okay, good stuff. Alex, I've really enjoyed this, man. Thank you for doing the podcast. I really appreciate it.
Yeah, man, it's been a pleasure. I appreciate it as well.
Hey traders, thanks heaps for listening to this episode with Alex. I really hope you enjoyed it. I just want to remind you, Chat with Traders event coming up in New York on the 2nd of May. If you're in the area, I do hope to see you there. For all the details and to reserve your spot, please go to chatwithtraders.com/NY. Hit me up on Twitter if you've got any questions. My handle is simply at chatwithtraders. Again, that link one more time. To reserve your spot, please go to chatwithtraders.com/NY. Thanks a lot, guys. If we don't speak in the meantime, I'll catch you on next week's episode.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast on iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
the foreign markets, particularly the really cheap stuff, and the entire history of the database that we have, certainly going back to the 80s and 70s, and thinking about stock opportunities.
Chat with Traders is brought to you by Trade the Pool. Did you know that? And now that means you can solution today.
Low commissions, including zero broker-dealer and member of...
It is welcome to episode 120. Thank you very much for being here. I'm glad you could join me. First up, I must give a quick reminder. I'm hosting a small Chat with Traders event in New York on the 2nd of May. There will be beers, there will be pizza, and I'll be doing a live interview with a trader, essentially like a live podcast. There will also be a number of past guests of Chat with Traders attending, so it'll be a cool opportunity to meet with some of them, and more importantly, meet up with other traders who are doing similar things and who have similar goals to yourself. It's only $12 for a ticket, and that includes absolutely everything. You can grab a ticket at chatwithtraders.com/NY. Just so you know, since I first announced this last week, more than 80 people have reserved their spot already, and I have a hard stop at 120 people. So please be quick if you'd like to come. And a special thanks to Trading Technologies and Sanglucci, who are both sponsoring this event and essentially making the whole thing possible. Avoid the FOMO, reserve your spot at chatwithtraders.com/NY. Now, on to my guest for this episode. My guest is Meb Faber. Meb is the founder and CIO at Cambria Investment Management, where he manages Cambria's ETFs, separate accounts, and private investment funds. He's also authored numerous white papers and 5 books now. Meb's a budding podcaster too. His podcast is called The Meb Faber Show. The main reason why I asked Meb to come on the podcast was to talk to us about some simple ways that active traders can capitalize on the opportunity and compounding effect that somewhat passive longer-term investing has to offer. So I asked Meb about where to start out, how to set expectations, various types of portfolios, when to enter the market, what to do during drawdown, what things new investors struggle with most, and so on and so forth. Throughout the interview, Meb does mention a fair few links and resources. I've curated all of these at chatwithtraders.com/120, so you can find everything there. I don't think I've missed any. And one last thing, in case we have some new listeners here, please keep in mind you're 100% responsible for your own trading and investing decisions. Now, please welcome Meb Faber joining us from California. When you first got into markets, Meb, where did you start out?
So my background's a little different. I was a biotech and engineering student at university, but this was during the late 90s. So a pretty exciting time in markets, both for internet as well as biotech. If you remember back sequencing the genome and all the fun stuff going on with genetics. And so, I spent a fair amount of my spare time investing and studying markets. And so had actually started out as a biotech equity analyst, taking a year off before going back to get my PhD. But that 1 year off certainly became 2, 3, 4, and started gravitating more and more towards the quant side of the business before eventually starting Cambria in 2007 here in Los Angeles with my partner, Eric Richardson. But if you wanted to go back really far, it's certainly with my father, chatting stocks and investments in business, for many years growing up. And I even found a postcard the other day that I had written from camp that was talking about how I thought it was a good idea for us to pick up some shares at Disney. So kind of a fun reminder at an early age. But yeah, it was instilled pretty early on.
And so what other roles have you had? Obviously you I think it's CIO and also co-founder of Cambria now, but what other roles have you had sort of leading up to that point? And I think you worked as a trader at some point also.
Yeah, so that it was started out as biotech analyst while I was going to grad school. And so that was focused on pure fundamental research, picking biotech stocks. And then it became a little more quantitative. I went to go work for a CTA, so commodity trading advisor, that I spent more of my time on trading systems, quantitative ideas, everything from very short term to very long term, but with a particular interest in what a lot of CTAs do, of course, which is a lot of what we do at Cambria, which is trend following concepts, long term trend following ideas that have been around for, of course, many decades. But and then had simply moved to LA in 06 and started Cambria in 07. And so, but it's a full spectrum from fundamental, technical, and then multi-assets from everything around the world, stocks, bonds, real estate, commodities, everything in between.
Well, tell us a little bit more about that. Like, how do you spend your time these days? What sort of things are you doing? What do you do now? What is Cambria, essentially?
I think a lot of professional investors that are listening to this will sympathize, or this next comment will resonate a little bit, is that you learn pretty quickly the difference between managing money and the business of money management. And what I mean by that is, simply coming up with trading ideas and systems and theory and research is totally different than running a investment business. And so there's a lot of people that are attracted to our world by, of course, the money and the compensation, but also the really exciting, complex puzzles that exist in the world economy and investing. But, also on the flip side of, spending all day on chatting with lawyers and the SEC and managing public funds and talking to reporters and all that good stuff that goes in with running a company and making sure people get paid on time. So what do I spend most of my time? I enjoy doing is certainly the research and something that's a bit of a surprise had you told me 10 years ago when we started the firm is of course writing. The first academic paper I ever wrote was an accident and published, and then looking back on it, it's kind of crazy now because we've published about a dozen white papers, 5 books, and I think the blog has going on 2,000 articles, which is a little crazy. So, but the writing has become part of the process. And so like we started a podcast last summer, which has been a lot of fun. So the day-to-day is kind of coming up with ideas or concepts to refine our process or to help implement or improve what we're doing. And in some cases, we have 8 public funds out there to actually launch new products or things that we look around and say, hey, I think this is a better mousetrap or a more interesting thing that doesn't exist that should. But the day-to-day that I would spend most of the time, what I like doing is reading and writing and skiing if I get the chance to. But this year's been a little light on the latter front.
Nice. Well, I mean, it sounds as though you've got a lot of things going on. I'm just interested to know, is there how would you categorize your style or styles of investing and trading? I mean, is it possible to categorize what you do because you do so many different things? Or is there is there an overarching theme to what you do?
There's a couple. So when we think of launching funds or any sort of money management that we offer to the public, is that there's a couple criteria. And we say, look, number one, does this concept or fund exist already? Because there's plenty of fund companies out there like Vanguard, multi-trillion in assets that provide a lot of products and they do it very, very well. 2, is it something that we think we can improve upon or that doesn't exist or that we can do cheaper? And we think there's still a lot of ideas out there that don't exist in the format that we think that they should. And lastly, for me, is it something that I want to put my own money into? And so unlike the vast majority of mutual fund managers, I think the number is something like ranges from 50 to 80% of mutual fund managers in the U.S. have $0 invested in their own funds, and on the higher percentages is less than 100,000. So, I have 100% of my net worth in our funds and strategies, and most of the people here do. So, is it something that you believe in and you want to invest in? And so, once you've said that, the funds are very different. Each one or each strategy ranges from funds that are very niche, that may say be a sovereign high yield bond fund. That's a very niche strategy, to something very broad, like an asset allocation fund that owns 30,000 securities around the world and is a super low fee. Now, that having been said, there are, and everything we do is rules-based and quantitative, which we think is important to remove the emotions out of the whole process. That having been said, there are two themes that kind of have their tentacles in almost every fund or thought process. And it's two concepts that have been around for over 100 years, ever since Charles Dow was talking about it with Dow theory and trend following. So that's one, and they're close cousins, but momentum and trend. And then two is, again, over 100 years old, is Ben Graham talking about it. And that, of course, is value investing. And so some funds are pure value funds. Some funds are pure trend following funds. Some funds do actually the combination of the two, which is if you had to pick one investment strategy or concept in the world that is the perfect synergy of everything I look for, it's value and trend or momentum. So basically something that's really cheap that's going up. But depending on the fund or strategy, those are the two main themes. And then, of course, we could talk about this at some point, but also the question of how does an investor holistically put together all these ideas into a portfolio and not go totally crazy with holding these two different ideas in their head.
Yeah, I mean, we're certainly going to get into that. I think that's going to sort of be the main focus of our conversation here. But I just want to go back to that stat you threw out. Something like 50 to 80% of asset managers don't actually have any money in their own funds. I mean, that seems really crazy. I'm kind of shocked by that.
Here's the funny part about it, and I know Nassim Taleb's got a new book coming out on this topic, which I look forward to, but it's either really strange and surprising or it's incredibly unsurprising. And so let's say the average mutual fund manager charges 1.25%. Average ETF is like 0.55%. In many funds, you can now get ETFs and mutual funds publicly for even like 10, 20 basis points. So in many cases, a lot of these mutual fund managers say, look, I know this fund is tax inefficient. I know that it's expensive. Why would I invest my own money in that? And that's a totally rational decision. Now, from the end fund investor, it's the last thing I want to see. I want to see that fund manager investing in their own fund. And this is one of the reasons the hedge fund space traditionally at least has that going for it. The traditional hedge fund fee structure is much higher, but at least most of these managers have a lot more skin in the game, for better or for worse. But, and it depends on the fund too and the different strategies, but Morningstar puts out a lot of research on this topic, which is where we sourced it. And I can't remember the exact name of the blog post, but I can certainly send it to you, that has the charts on this topic. But yeah, it ranges depending on the type of fund, but in some cases, yeah, it's as high as 80. I think 80% have either nothing or less than 100,000 in the fund.
Right. Very interesting. Yeah, we might try and dig up that link and I'll put it in the show notes if anyone's interested to read up more about that. But as we hinted, Meb, obviously I reached out to you and you're aware of this. One of the reasons why I was really keen to bring you on the podcast is because I kind of want to speak to you about how active traders who trade very short time frames, either intraday or swing trading, holding positions for a couple of days, how short-term active traders can sort of tap into the opportunity of a longer-term, bigger picture investing as well. Something that requires less input than it does to be an active day trader, for example. But something that is reasonably simple, reasonably robust, just some actionable tips and ideas for how we can sort of take advantage of that, the compounding effect. So I guess, on this point of conversation, what is a good starting point? I mean, let's just start right there. I mean, most of my questions, just so you know, are going to be fairly basic, but because I think this is quite new to a lot of people. People who are even advanced traders, I think some of them tend to neglect the investing side. Obviously, that's why I brought you on here. So what's a good starting point? Hopefully that made sense.
No, it does. And I think it's one of the most important things an investor can do. And so people, and it doesn't just matter if it's with investing or relationships or work, one of the most important things people can do in life is understand expectations. And so I saw a recent survey recently asked a bunch of investors around the world, what do you expect stocks to return? And same thing in the US, and of course asked some millennials too. And I think that the average response is they expect stocks to return 10.5% or something going forward. And there's a couple comments on that. And so one is to say, all right, the first thing we need to do is set our base case and understand, what does history look like? What are the worst case scenarios? What are the best case scenarios? So my favorite investing book, which I highly recommend, it's expensive, so go get it at the library if you're listening. It's called Triumph of the Optimist. It's written by a couple of British professors. And it takes a look at the history of markets going back to 1900. And there's been some other variants of this. Ibbidson's done it. But this one in particular looks at about 20 global markets. So it looks at, say, for example, here's what the world looked like in 1900 and the sector composition and the global composition of markets. And then here's how these markets did since 1900. And here's an example. I mean, by the way, if you Google Global Investment Returns Yearbook, Credit Suisse does an annual update to this book that's free. So you can probably get about 10 years of this for free. That is probably the best investment writing that you can read. Highly recommend it. Anyway, so what's the historical results look like? So U.S. has done about 10% a year in stocks going back to 1900. And then if you look at bonds, they've done about 7%. And I think bills had done about 6%. So going back to 1900. Sorry, that might be a little bit too high. But the real return, so net of inflation, is that stocks did 6.5%, bonds did around 2%, and bills did around 1%. So you lop off that 4% inflation, and you get down to those numbers. Now, the U.S. was one of the best performing stock markets in the world over that period. It went from kind of this emerging market to now the global superpower. The best performing stock market in the world, I think, was tiny South Africa. And then the worst performing is Austria. Basically had zero returns over the entire period, real, so after inflation. And that's not really the worst case scenario. The worst case scenario is China and Russia shutting down their capital markets completely. So essentially your investment there went to zero when the government said, thank you very much, we're going to take your investments away. So that's the base case scenario. And so we like to call it the 5-2-1 rule, meaning after inflation, stocks globally have done about 5% a year, bonds, and I'm rounding up, about 2% a year, and bills around 1%. And so every deviation from that, you got to start with that as the starting point. And you say, okay, U.S. stocks, they've also declined by 50% multiple times. So most people are familiar with that, global financial crisis, dot-com bust, but they also declined over 80% in the Great Depression. And Charlie Munger and Warren Buffett often say this, as many others. They say, look, if you're not willing to invest in stocks and experience quoted securities having a 50% decline, you shouldn't be in stocks in the first place. So that's a lot of just kind of, here's the base case scenario. So you should never be surprised if you buy a stock market, for example, and it goes down 80% or 50%. Now, you can come up with probabilities and projected outcomes based on a lot of other things we'll talk about, I'm sure, at some point, like valuation. But in general, you have to assume that potential outcome. And then so people say, okay, well, stocks sound pretty risky, even though they have higher returns. What about bonds? Well, bonds suffer from a much different risk, which is usually not the price crash risk, but it's really the long eroding effects of inflation. So while bonds on a nominal level have only declined by about 20%, bonds after inflation in the US in particular, but other places around the world, have declined by half. So in many ways, bonds are equally as risky as stocks, but it's a different risk, which is inflation, whereas stocks, typically, it's more of a manic depressive Mr. Market risk and the price change. So the solution for many people, first thing they do is they say, okay, well, I'm going to diversify across U.S. stocks and bonds. We'll do a traditional 60-40 portfolio. And you get a little bit lower return than stocks, but you get lower volatility and drawdowns. Well, the problem with that portfolio is it's the volatility of stocks still dominates the portfolio. And so you have a portfolio that still ends up with very high drawdowns. We're talking 2/3 at some point. You can't really find a global market that hasn't had 2/3 drawdown at some point in a 60-40 traditional institutional allocation. And most investors, if you were to tell them, man, here's your basic moderate portfolio, 60-40, and you're going to lose 60% at some point, that's way too much risk for them. And it's really hard. And that's why you see so much bad behavior by investors when markets do poorly. And there's a lot of research that comes out that shows this, that people over and over again, based on their emotions, will sell at market bottoms, buy at market tops, rinse, repeat. And part of that's just because we're human. We're not really built to trade shares of IBM and wheat futures, but really the flight response and the greed takeover. And it's just part of knowing the history, at least, of what's capable and what's happened in the past can at least help you just take a step back and say, okay, let me implement some sort of rules-based policy portfolio or process to avoid me acting like an idiot going forward.
Okay, now when you talk about, just for example, stocks have returned X amount over, the last 100 years or whatever, when you say stocks have returned, are you talking about, the stock market index?
Yeah, so we're talking about like what we call a market cap weighted index, which means in the U.S., the good example is S&P 500. And this is actually a good talking point where the market cap weighted index, which weights, so the S&P 500 means you put the most in Apple and the next in whatever it is, Walmart, Exxon, et cetera. You put the most in the biggest stocks all the way down. And that reflects the market. That is literally the market. If you were to go out and just buy, quote, the market, that is the sum average of what everyone's going to have. Well, there's a couple comments on this. So one, a lot of people don't know this, particularly in the U.S., and this is a point of bad behavior also, is that, so if you look globally, the U.S. is about half of world market cap. And so that means the rest of the world makes up the other half. And the problem in the U.S., for example, is that most investors in the U.S. invest around 70% of their equity allocation in the U.S. And that's called home country bias, meaning they put way more in their own market than other markets. And it's a normal thing for people to do. It's the same reason I cheer for the Denver Broncos and I like skiing, is that, all these other things, is that it's comfortable. It's what I'm used to. It makes sense. But the irony is that it happens in every country around the world. So Aussies just as bad, Brits just as bad, Japan and China even worse, where these markets, people in the local country place way too much in their own market relative to the world percentage. And that gives you a massive uncompensated risk, which is this concentration risk. And you could ask anybody in Greece or Brazil or Russia the last few years in these countries that have declined 60 to 90%. And I'd say that was probably a really dumb thing to do, but it also applies to stocks. A lot of people, say, for example, may work at a company and invest in the stock of the company in their retirement plan. And so they're really like triple leveraged to the company, one with their job, one with the money going into their retirement plan, and three to the broad market as well. So that sort of risk and that sort of concentration, while market cap investing is the market, it's also a very suboptimal way to invest. And we can get into that if you want. But, a lot of people, to further clarify what market cap investing means, is a lot of people will say, hey, look, the S&P 500, what's that? And I'll talk to friends and they'll say, well, it's the 500 largest companies in the US. I say, right. Largest by what measure? And usually my friends will say, well, probably like earnings and revenue. I say, no. The only measure that matters is simply the price of the stock times the shares outstanding. And that's what we call, that's market cap. That's how big the company is. But it actually has nothing to do with whether the company makes any money, whether they ever sold one widget ever, whether they have any revenue, anything, whether it's a good value, whether the stock's super cheap or inexpensive. All it is how much are people willing to pay for the price of that stock. And so if you were an alien and came down and said, is this a reasonable way to invest? I don't think anyone would think it is, but that's the market cap investing. Now, the pro of that is that by owning the index, and this is one reason why it works historically, is you're guaranteed to own the winners. So you're guaranteed to own Apple Amazon, McDonald's, all these stocks that have had incredible performance. And the historical results show that it's actually a subset of all of the stocks out there, maybe 20%, that deliver all the gains. So market cap investing is a good first step, but it's not an ideal way to invest.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one position, using active as a registered broker-dealer and Pool's limited risk platform. With zero locate or trade yet, trade the pool on.
Now, just before we go any further, obviously I kind of outlined my reasons for wanting to bring you onto the podcast here. And I just want to go back to that a little bit. Is it slightly naive to think that you can do well in investing with, what's the right word, with limited input? You know what I mean? Because like I said, one of the reasons was obviously active trading is very time intensive. I kind of see longer term investing as something that does require less input. I'm just curious to get your opinion on that. Like, is that me being naive? Because if someone said they wanted to be a trader with very little time input, good luck. Is it the same with bigger picture investing? Obviously, it takes up a large part of your day, but you're doing, many things. As someone who wants to take more of a passive approach, is that reasonable?
So here's the beauty is we wrote an article a couple of years ago, I think, called "It's a Wonderful Time to Be an Investor." It's probably the best time to be an investor in the history of investing as far as access to low cost portfolios. And what I mean by that is any investor could go out and buy a handful of Vanguard funds. They could buy our asset allocation ETF, and boom, in one shot. And there's even brokerages that don't charge commissions at this point. There's the advent of all of these digital advisors that now do it for you. So it's very simple, and you could just go sign up for any of these digital advisors. We have one, Vanguard has one, Schwab has one, but you could also just go buy all-in-one fund, and meaning you get all of these things for a super low cost and a very, very tax-efficient vehicle. And that's awesome. You go back 20, 30 years when these brokerages would charge 3%, or even 10 years ago. And the scary thing is that a lot of this still exists in the world. So the flip side of this is that you've never had more access to dynamite to blow yourself up as well. The ability to have an app on your phone, and you can trade all day long and not pay commissions and, check your balance every 10 seconds if you wanted to, are all things that probably don't help the long-term approach. Probably helps your world a lot, but doesn't help the long-term investment approach. And so there is a lot of awesome solutions out there. And, we try to be honest and agnostic and say, look, obviously we think we have some great solutions, but there's plenty of other great shops, Schwab, Vanguard, et cetera, BlackRock, that you can invest in a couple of these funds, not look at them again for 10, 20, 30 years and be just fine. The beauty of these, what people call these digital advisors or robo-advisors now, and there's a handful of them in the US to where they'll give you you take a questionnaire, they give you a portfolio of, say, a dozen funds, they rebalance them for you, they tax manage them for you, you do literally nothing. And so to the person that wants a good solution and needs to spend, 10 minutes a year, if at all, it's never been a better time. And we can get into some specifics on how some of these are better than others and how some are still terrible. I mean, the bad news is that most of the investment world for even this long-term holdings still charge huge fees and can be very predatory. So if someone doesn't know what they're doing, you can still go down the route that our parents and grandparents do. But the good news is that most of all the news flow and fund flows demonstrate that it's kind of a one-way street. Most people don't go from a high fee, tax inefficient product where someone isn't a fiduciary to someone who by law has to be in your best interest, low cost funds that are tax efficient and perform well. Usually that's a one-way street, and usually it's a generational process that people they'll sell off their funds when they die. or get divorced or inherit the money. I mean, there's a stat in the U.S. that the average financial advisor that's been in business for, I forget, it's either 10 or 20 years, owns 200 mutual funds for his clients. And that harkens back to the days of, these salespeople showing up and selling a fund and getting a 3% commission, and the fund costing 2% a year plus 12B1 fees plus a front end load. Well, that world doesn't really exist. I mean, it still exists, but it's dying a very, very quick death. So the good news is it's a wonderful time to be an investor, and you have never had better access to low cost products. And I'll even give you one more stat that a lot of people don't know. So for example, let's say you have an ETF, exchange traded fund, that charges 30 basis points per year. And so 1/3%. So it's super low already. Many of these funds actually will go and lend out some of the securities to short sellers on margin, and then they will return the short lending revenue to the fund shareholders. So there are a handful of funds out there that actually have a negative expense ratio, meaning they're paying you to own the fund. And that's a pretty cool thing, right? If you think about it, what a time we live in to be able to own an investment portfolio where the management fee is actually negative.
So you're talking about some of these robo-advisors, which are becoming increasingly popular. If someone was willing to put in a little more effort, you said if you go down that path, you could spend 10 minutes a year to manage your longer term investments. If someone was to put in a little more effort than that, what's their chances of achieving better performance over the long term?
So this is an interesting question, because to me, the beauty of a lot of the funds and strategies now is that if you go back to the 70s, when John Bogle invented the index fund, that used to have a certain meaning. That meant market cap weighting, low turnover, low cost. And that's what an index fund was. So something like the S&P 500, right? Well, it's that definition has been totally polluted over the years, because active management used to mean is, hey, here's a manager who's trying to beat the S&P 500 and he charges 2% a year, and there's very little chance of him doing it, and it's tax inefficient. So that's why index funds have now grown so much. They're about, I think, 1/4 or 1/3 of the overall market. Well, however, all index funds have become at this point is rules-based process. So, for example, we were talking about how market cap index weighting S&P 500 is a good first step. But if you weight the stocks in the S&P 500 by almost any other methodology, you could equal weight them. You could weight them based on like a value metric, something like price to earnings ratio. People used to talk about dividend yield and the dogs of the Dow. So any of these weighting methodologies will beat the S&P 500 by 1% or 2% per year, going back as long as we have data to the 20s. The reason being is that market cap weighting has no tether to value. And so once you break this market cap link and you start to tilt towards value, so buying a stock that has a lower PE ratio or a higher dividend yield, you end up outperforming the S&P 500. Well, the good news is you can now get those rules-based objective portfolios for also very low cost. So you have indexes that are what people would have used to have called active management, but that are low cost, tax efficient for super low cost. So that doesn't necessarily require you to put any additional effort, really only up front. So we talk about this in a white paper we published called the Trinity Portfolio. It's free online. We'll give you a link in the show notes. And we kind of go through this holistic process of how to build a portfolio. So we start out with the US 60-40, and then we expand to global 60-40. And by the way, adding global assets doesn't really increase your returns or reduce your risk that much. What it does do is it reduces the possible extreme scenarios. So if you put all your money in Greek bonds and stocks, for example, that would have shown to have had a very negative outcome over the past decade. On the flip side, if you put all your money in U.S. stocks, and bonds, you would have done much better. But a global gives you kind of the average. So you'll never be the best or the worst, which is good. The second thing you can add to the portfolio is some traditional real assets. So think about that as real estate investment trusts, commodities, things like energy related or gold, things like treasury inflation protected securities, so TIPS, because a lot of those help protect against inflation. In the 1970s, as an example, very poor period for traditional assets. So once you have that portfolio, and by the way, we kind of call that the global market portfolio, and that looks like as you just went out and bought the entire world. So if you just said, I'm going to buy with one ETF, and we actually have one that does this, I'm going to buy with one transaction the entire world. I get 30,000 securities around the world. I don't have to do anything. Okay, that's a good stop, okay? Now, next step, if you said, all right, I want to improve upon that because I think Meb said market cap investing isn't ideal. What can I do? Well, the next step is you start to tilt towards things that have historically worked. And the two things we talk a lot about that academics have written thousands of papers on and thousands of books is value and momentum. So if you tilt these stock indices away from market cap to value and these indices towards momentum, those are both things that will increase the risk-adjusted return as well as the absolute return of that portfolio. So that doesn't really require any effort. Once you select the funds, you don't have to do anything because they rebalance themselves once a quarter. So all you have to do is simply monitor and rebalance it maybe once a year, even every couple of years. Now, the biggest departure I have from almost every other investment manager in the country. So if you look at all these robo-advisors, and we've done posts on this, I sound like a broken clock, but we'll give you show notes where we compare Vanguard and Schwab and Goldman Sachs and Wealthfront and Betterment. And they basically all do the same thing, which is give you that portfolio I just mentioned. The global market portfolio, stocks, bonds, a little bit of real asset. And that's a great thing. That's better than probably what 90% of people have out there. Now, the departure that I have is that it doesn't include an investing approach called trend following, which you've probably talked about on this podcast before, which I think for me personally is an investment strategy that I believe can give a more stable and consistent investment returns, as well as having the potential benefit of not sitting through long bear markets. But I think either approach is actually great. And the conclusion of this paper was, if you had to put a gun to my head, desert island, which portfolio would I pick? I would certainly pick the trend following portfolio, but it has its own challenges. So buy and hold, the biggest problem with buy and hold global portfolio is the long bear markets and drawdowns. 2008, right? So when everything's hitting the fan, people panic and sell. A problem with a active trend following portfolio is not necessarily in 08, because usually those do well in that sort of environment, but actually it's in the years that follow where you look different, where you do poorly in a year when everyone else is doing well. When your neighbors are getting rich by buying Snapchat and everything else, and you may not be doing, as well. So we said in this paper, the conclusion was kind of to put the two ideas together, 50% each, to diversify not only your portfolio, but also your psychology. So there's a lot of ideas in there, but my point being is that, and we wrote a recent article about this called the Zero Budget Portfolio, the vast majority of listeners don't have a written investment plan. So if you're listening to this right now, raise your hand, be honest with yourself. Do you have a written investment plan? I'm guessing 1% do. And then second, have you shared it with your wife, daughter, father, neighbor to keep you accountable? And unlikely the answer is yes, and this is why this is so important, is because the emotional component with the long-term investing is usually by far the biggest problem. So it doesn't really matter what the investment portfolio is so much, but once you set it, you don't have to monitor that much. All you have to do is keep yourself away from yourself.
Okay, well, speak to us a little bit about that. So what sort of things would you want to include in an investment plan? Like, what would one look like? And just to take it one step further, I think this is also quite important, is actually talking about your investment goals. So how would you suggest thinking about investment goals? Because obviously for most people listening to this are traders trying to hit much larger returns than what you're going to achieve from, a slightly passive with a little bit of active investing. So yeah, what are your thoughts around that?
Let me, I'll get to that, but let me give one quick point to explain why this is so important to write it down. So there's an investment survey that goes back to the 80s called the American Association of Individual Investors. And they asked their investors, are you bullish, are you neutral, or are you bearish on the stock market? And so no surprise, you've had a very wide spectrum of responses going back to the 80s. But if you look at the historical results and you find that the highest bullish rating ever in the entire survey was in January of 2000. So the literal worst month to ever be investing in U.S. stocks in the entire history of the survey was when people wanted to buy the most. And say, on a flip side, when was the highest bearish reading? It was in March of 2009. And you couldn't have made up a more awful response to that survey than what the reality was. But again, going back to the point of that's why people are human, you wanted to do the exact opposite of what all of those people did. And so if you don't have a written investment approach, then you're simply flying blind. And when January 2000 comes along, you're going to be excited about buying pets.com and CMGI because your neighbor and broker are, and they're making tons of money. And the same thing happens in March 2009. You're going to be panicking. You're not going to know what to do. And so there's a lot of elements that it can be included. And so there's a lot of different people out there with different goals. My mom, for example, perfectly happy to sit in CDs. She sleeps at night, and that's what we say is the most important. Do you have a sleep at night portfolio? So a lot of people, first step, do you have 50 grand in the bank or, 1 or 2 years of expenses that you can cover your investment, your lifestyle? And if you don't really need to be putting the rest at risk because these, as we mentioned, these markets can have large drawdowns. And so 2 would be to write down, hey, look, the robo-advisors do a good job of this. Traditional financial advisors do a good job of this. Traditionally, they charge about 1% a year. And so if you don't have an advisor, we think they can be worth their weight in gold if you don't feel like you can trust yourself. And a lot of people can't. But at the same time, that 1%, that 1% cost is a very real cost. So if you don't need one, you shouldn't be paying it. And I forgot to comment on this, but we can talk about this asset allocation cost in a minute. But writing it all down and coming up with all of the inputs that you may have, and financial advisors are great because they'll provide you with a plan if you've never crafted one. But it could also be as simple as, hey, look, I'm going to buy this diversified portfolio of ETFs and rebalance it every 5 years. And that's it. Like, that's a policy statement. But in your head, you have to have the ability to say, is this going to stay consistent if gold goes to 5,000 or if gold goes to 200? If stocks go up 80% or down 50%? Are these scenarios or am I just going to watch CNBC and, react emotionally? Because usually that's the kind of worst kind of way to go about it.
As we're talking about, these major drawdowns that obviously happen from time to time when you're a buy and hold investor, what do you suggest actually doing in those periods? Like, obviously, I know you mentioned before, you said it's a good idea to, one option is to be 50% invested in trend following strategies and 50% in buy and hold. So they kind of balance each other out. But when you're in, let's just go back to the prime example of 2008, the GFC. What would you suggest for buy and hold investors to do in periods like that? And maybe periods that aren't even as severe as that, but when you're in major drawdowns or downtrends, what can you do as a buy and hold investor? Is it best to just ride that out, or how do you deal with that?
So there's a couple comments. So if you are a buy and hold investor and that's your policy portfolio, I'm going to buy and hold, I'm just going to go about it, and then you do nothing. And you accept that drawdowns are a natural part of life. Because here's the problem with drawdowns is that markets spend the vast majority of time in drawdowns. They only spend about, I think it's like 20% of the time at new highs. And there's only 2 states. It's either all-time high or drawdown. There's nothing in the middle. And the problem with drawdowns is it gets exponentially worse the more they go down, right? So people often talk about compounding being the 8th wonder of the world. Well, unfortunately, the opposite is true to the downside. So it gets asymmetrical, and the kink really happens around 10, 15%. So you lose 10%, you only need 12 to get back to even. You lose 20, you got to get 25 to get back to even. You lose 50, requires 100% to get back to even. And if you lose 75%, requires 300%, right? So it's much harder to come out of these drawdowns. And the problem is you never know how bad it's going to be. So yes, theoretically, if you knew that stocks were only going down 50% in the global financial crisis, you should have loaded the boat in stocks, right? But the challenge is that 50 could have become 80. Here's where valuation helps. And so we've written a book on this topic called Global Value. And the way that valuation helps is it acts as a fundamental anchor from which you can use common sense. So here's an example. We use a valuation indicator called the 10-year PE ratio. Robert Shiller popularized it in a late 90s paper and book called Irrational Exuberance. Then Alan Greenspan used the phrase in court testimony, which made it popular. But it goes back to something that Ben Graham was talking about 100 years ago, where you look at a PE ratio, you average it out over a number of years to help average out the business cycle. And so for the S&P, going back to 1900 or U.S. stocks, for example, that value has been around 17 over time. Now, it's been as low as 5, and it's been as high as 45 in the dot-com bubble. And not surprisingly, if you group stocks into buckets of valuation, so 0 to 10, 10 to 15, 15, 20, above 20, in each bucket, it goes a stair step. So when the market's the cheapest, so below P ratio of 10, future returns are very high, 10-year returns. And this isn't a market timing indicator for the next month or quarter, but this plays out over years. And then when markets are normal, you're going to get 10% returns. And then when markets are expensive, you're going to have very low returns. And this has worked very well over the past 120 years. And so where we are right now, so here's what's interesting. So you went back to 2000, trading at a value of 45. No rational person would say it makes sense to be paying 45 times earnings for the S&P 500. And it gives you that kind of common sense takeaway. Now, in March of 2009, it got that what we call the CAPE ratio got down to a value, I think, of around 13. So really cheap. Not extremely cheap, but really cheap. And then where do we sit today? U.S. stocks have been the number one performing stock market in the world since 2009, which is very rare. Usually, U.S. versus foreign stocks is a coin flip. It's literally 50-50 as long back as we have data, which outperforms. And so you've had this massive outperformance in U.S. stocks. So U.S. stocks now trade at a CAPE ratio of 30, which is one of the highest values we've ever seen. It doesn't mean it's a bubble. I don't think that bubble really until you get into the high 30s or 40s. And it doesn't mean they have to crash. It just means future expected returns are going to be lower. So going back to the expectations and ideas we were talking about earlier, historically people have been expecting 10% for stocks. We think that value going forward for the next 10 years is probably around 4. And then you add on U.S. bonds at, say, 2.2 or 2.5, and there's no way that 60-40 portfolio is going to have the expected returns historically of what most pension funds and endowments expect of 8%. And so one of the things that people need to realize if you're looking into those assets is expectations need to be a lot lower. Now, the good news is the rest of the world ranges from reasonably cheap. So we were the first people to do this, but a lot of others do it now, where we built CAPE ratios for every country in the world. And so foreign developed sits around that 16 range, which is totally normal. Foreign emerging is down around that 13 or 14 range, which is quite cheap. And the cheapest quartile of stocks, so the 12 of the 45 cheapest countries in the world, is at a P ratio of around 10. And that's one of the biggest discrepancies between U.S. stocks and the foreign markets, particularly the really cheap stuff, in the entire history of the database that we have, certainly going back to the 80s and 70s. And thinking about stock opportunities, a long-term investor, you could either A, allocate to a fund that does this. So you could allocate to a fund that naturally rebalances into the cheapest countries, and we have funds that do that. Or B, when you're reviewing your portfolio on a yearly basis, take a step back and say, okay, and remarking about in the U.S., we were talking about earlier, where U.S. investors put 70% in the U.S. We say, you know what, maybe it doesn't make sense to be putting the most in, we calculate the second most expensive country in the world currently. Maybe we should be paring down U.S. stocks and allocating to foreign stocks, and particularly the really cheap stuff. And the interesting part about this is it's not always the U.S. The U.S. used to be one of the cheapest countries in the world when it hit a value of 5, and it could certainly go higher. It could hit a value of 45, and even higher than that, Japan hit the highest value we've ever seen in the 80s when it hit a P ratio of almost 100. But then Japan had terrible market returns for the next 20 years in what people call the lost decades. And it's not like Japan was some backwater economy. Japan's market got to be the largest by market cap as a percent of the world back in the 80s when it got to almost half. So if you're a global market cap investor, you had a minus 2% per year drag on returns because of investing in Japan during that period. So thinking about value and starting to tilt away from what common sense would dictate, and particularly in the U.S. right now, also applies to traders and short-term traders and traders working at banks, because many of them have additional exposure through their retirement plans or through their job, et cetera. But that's a easy indication, we think, that helps improve upon just the base case portfolios.
Now, just so we don't lose anyone, when you're talking about the CAPE ratio, what exactly is that referring to, and how's that different to a PE ratio?
So the CAPE ratio is a PE ratio. PE ratio is simply price to earnings ratio. And the CAPE ratio is, say, let's take a 10-year average of the PE ratio. So, and it also adjusts for inflation. So trying to compare apples to oranges over time doesn't make sense. So adjusting for inflation makes a lot of sense. And historically, we've done a lot of simulations with various PE ratios, and the worst one to use is the 1-year PE ratio, usually because it's so volatile. But the longer term metrics, whether it's 5 years, 7 years, or 10 years, work a lot better because they reduce turnover as well as have a longer term focus.
Okay. Now, I think this next question probably leads on from your last comments there. Let's talk about timing, like timing when to begin investing. Like, there's a lot of talk going around at the moment, as there always is. There's many people think the stock market's about to fall out of bed and all the rest of it. I'm not saying that it is or isn't. I really have no opinion on it. But there are people who do have the opinion that, we're going to see some severe downside. How do you time getting into investing? Because, if you'd bought any time in 2007, obviously 2008 would be very tragic. You've had to wait many, many years to get your money back and to even start making some returns. So how do you time getting into investing? I know that wasn't very well worded, but I think you know what I'm getting at.
Yeah, we deal with this question a lot with individual investors that are asking the same question, Meb, when do I get in? And should I jump all in, or should I spread it out? Should I wait? And my first response is always, look, a global portfolio, you're not just investing in one asset class. You're investing in U.S. stocks, foreign stocks, U.S. bonds, foreign bonds, real estate, commodities, everything in between. So there's a huge portfolio of different assets. However, even if you were investing in just one asset class and say U.S. stocks, the correct mathematical choice is to invest all of it now. Now, that may not be the correct emotional choice. A lot of people have a big problem with regret and hindsight bias. So if you were to invest it all in 2007 and the market crapped out in 2008, a lot of people emotionally and psychologically would have really struggled with that decision. They would have pulled their hair out and said, man, that was really dumb. I wish I hadn't done that. I should have waited a year. That was stupid. So we say, even if it's irrational, we're totally fine with people spreading out dollar cost averaging into their investments into as long of a time frame as they feel comfortable. They can invest every month for the next 5-10 years if they wanted to. And that traditional dollar cost averaging is a great way to go about it. But in general, the correct math is everything now. However, if you were to ask that question as a specific market, like we were just talking about U.S. stocks and valuation, and say, look, the way that we liken it is it's like playing blackjack. And so you have a stock market that's trading at a PE CAPE ratio of 30, so very high historically. It's kind of like sitting down at a blackjack table and watching someone have a 16 versus the dealer's 10 up card. And historically, that's a hand you're very likely to lose. It's not guaranteed, but you're likely to lose. And the flip side, let's say you have a 19 and the dealer's showing a 6. Chances are you may win that. Chances are you should win that hand. Okay, so it's the same thing with valuation, where we're trading at a P ratio of 30. Chances are returns are going to be low. Could they go higher? Absolutely. But is the more likely scenario that they go down or sideways? Probably. And so in a scenario where you take a common sense approach, and if you were only investing in one asset class, you could say, look, like an expensive U.S. stock market, you could say, okay, I'm going to invest, but here's the rules. I'm going to dollar cost and average until this gets back to an average valuation, et cetera. Granted, I think the better way to do it is invest in a global portfolio, start all now, because one of the things we learn from compounding is the earlier you start, the better, and make time work for you.
Sure. Yeah. Fair comment. I also want to go back to a comment you made a little earlier. You brought up rebalancing, and that's something we haven't really talked about too much, I don't think, unless it's sort of slipped past me. But how do you think about rebalancing? And just to bring it right back to basics, what's the point of rebalancing your portfolio?
So let's say you have a portfolio that's 60% stocks, 40% bonds, and stocks have a monster year, and they start to drift to where now your portfolio is 80% stocks and 20% bonds. Well, that may give you an exposure that has drifted from your original intended portfolio. And if given a long enough time horizon, those two assets, because stocks historically have had a much longer, a much higher return, that portfolio is going to eventually end up being 90% stocks or 95% stocks and 5% bonds. That having been said, there's been periods of 20, 40, 60 years where stocks don't outperform bonds. But in general, the evidence has been stocks, Jeremy Siegel's famous phrase, stocks for the long run, stocks have outperformed bonds. Now, the more assets you have, the less it matters. So what we often say is rebalancing is good to do as long as you do it sometime. So even on a yearly basis, you rebalance the target. It gives you the nice discipline of selling the winners, adding more to the losers, and rebalancing back to target. However, in a multi-asset class portfolio, you could do that every even 3 to 5 years, and it's not going to make a difference. It only matters that you do it sometime. So if you left it for 20 years, then it gets kind of out of whack. So really rebalancing, I think, is, and the biggest consideration is to do it, make sure you do it tax efficiently. So you're doing it to where you're not paying a lot of taxes and doing it smart, but it doesn't matter that much as long as so the true lazy man, these global asset allocation portfolios can be very lazy. You could buy into one and not do anything for 5 years if you wanted to. But we often say yearly because it's just a nice habit to say, hey, I'm going to look at my investment portfolio once a year, make some tweaks, and that's about it.
Okay. Now you brought up tax considerations and doing it in a tax efficient way. I mean, I know everyone's tax situation is different, and I mean, we've got people listening to this podcast in however many different countries. Just broadly speaking, is there anything you can add around the idea of doing things tax efficiently?
Oh boy, there's a lot. And let me sort of, I'm going to talk about taxes, and then I want to talk about fees too, because if everyone listening hasn't fallen asleep yet, they're probably going to nod off now. But the irony is they're probably the most important determinants of your future performance of your portfolio, vastly more important than your asset allocation for long-term investors. And let me explain why. So taxes, if you look at traditional investment options, so let's compare an index fund to a actively managed mutual fund to a hedge fund, right? And so let's say that we're targeting a return net of all expenses of around 8%. Well, the index fund, you only need to have about a 10% return to have a net of 8% return after all taxes and fees, because likely the transaction costs are low because the fund doesn't have much turnover. The management fee is only 0.1%, and you're not paying a whole lot on taxes and dividends because it's a fairly tax efficient portfolio. Still pay it on dividends, but not on taxes. So you really only need a 10% return to get to that 8%. An actively managed mutual fund, because it probably has 100% turnover, and because the management fee is that traditional 1.25% that we talked about earlier for mutual funds, you all of a sudden need to have over 13% gross returns to get that 8% after tax. So that mutual fund manager, and this is why the high percent of mutual funds fail to beat the indices, is because of the high turnover and the high annual fees and costs. And then lastly, you have our hedge fund friends, which charge 2 and 20 and have probably even higher turnover. You need to generate a 19% gross return to get to an 8% net return. And that's one of the biggest problems with a lot of hedge funds. People see them as being very sexy, the high returns potential, here's the great stuff they're buying, very swashbuckling. But the problem is, particularly in taxable accounts, you really want to avoid them in many cases because they have to generate a massive amount of alpha just to break even with an index fund. So that's just kind of illustrate the importance of taxes. And there's a lot of other things you can do, say, try to optimize where you hold the assets, whether in taxable or tax efficient accounts. We actually did a blog post, which we're not going to go down that rabbit hole because it's probably a whole nother hour-long topic, is talking about avoiding dividend yielding and yielding stocks in general in taxable accounts because they underperform once you include tax on dividends. But the one segue that I wanted to make that I think I should have mentioned earlier that I think is profoundly interesting is in our book, Global Asset Allocation, we look at, when we're talking about these asset allocation portfolios, we went around and said, this is interesting. There's been about a dozen super famous guru investors. So we're talking Dave Swinson of Yale, Warren Buffett, Mohamed El-Arian of PIMCO and Harvard, Ray Dalio runs the largest hedge fund in the world. These guys that manage trillions that at one point have stated, here's a recommended asset allocation portfolio for an individual investor. And so in the book, we said, okay, well, let's examine how all these portfolios have performed all the way back to 1972. And they are vastly different portfolios. Some put 25% in gold, some put 0, some put 50% in stocks, some much lower amount. And so these portfolios look very, very different. With the exception of the permanent portfolio, which isn't really fair because it has half the portfolio in cash and bonds. These portfolios, all dozen of them since 1972, performed within 1 percentage point of each other. And to me, that is an astounding statistic. And so here's the fun experiment. If you went back to 1972, and I said, Aaron, I'm going to give you a crystal ball. I'm going to let you pick the single best asset allocation portfolio out of my book for the next, 35 years. How much would somebody pay for that? How much would PIMCO pay for that? Billions? Absolutely. I said, however, here's the catch. You have to implement that portfolio with the average mutual fund fee today, 1.25%. Let's not even talk about the average mutual fund fee 30 years ago, 2-3%, but 1.25% today. Would you take that deal? Everyone would probably say, absolutely. I get the best performing portfolio. So that would have been the El-Arian portfolio, which is endowment-like, so very heavy exposure to growth and equities. Had you implemented that portfolio with the average mutual fund fee, you would have transformed the best performing portfolio in my book to almost as bad as the worst. So the takeaway being that most people, what do they spend their time thinking about as long-term investors? Their asset allocation, are stocks expensive? What about gold? How much should I put in bonds? What should I be buying Greek debt right now? Is the real estate market, how's that going to do in a Fed rising environment? And what should I do about Bitcoin? All these questions that people spend all their time sweating and thinking about, how little do they think about fees? If you had to go a step further and said, you know what, I don't trust myself, so I'm going to hire an advisor, pay him 1%. He's going to allocate it to a great portfolio of mutual funds at 1.25%. That would have taken the best performing portfolio and made it far worse than the worst performing portfolio in the entire book. And that, for a lot of people, is a tough kind of pill to swallow. They want to think about the exciting parts about investing, which are, the stock market and everything else, but really the boring blocking and tackling of taxes and fees is likely going to have a much bigger impact on your portfolio than everything else we talked about over the past hour.
Right. Well, that really puts things in perspective.
Or puts people asleep, one or the other.
All right, Matt. Well, let's summarize some of the things we've been talking about over the past 60 minutes or so. So from what you've seen, where do most people struggle the most?
It's unquestionably with their emotions, and we see this over and over again, and it has different flavors, of course. But our Canadian friends who are flipping real estate houses right now are probably getting to see it, and they're having conferences where Pitbull is hyping people up about investing in real estate to, you see these sort of bubble. We've written papers on, one was called Learning to Love Investment Bubbles, and it goes back to the South Sea bubble in the 18th century and talks about all these famous bubbles across history. And you see them rinse and repeat over and over again. And I think the biggest challenge for people, one, is they don't teach, at least in the U.S., they don't teach personal finance or investing in high school. It's not a core curriculum. And for most people, they don't teach it in college, unless you're an economics or investment major. And so a lot of these concepts, what is probably the one skill set that every human being on the planet uses the most? And it's personal finance or investing, and how to just deal with money. And so the biggest challenge, I think, is coming up with an investment plan that's logical, that you can implement, that's based on history, and sticking to it. The biggest key being sticking to it, and not getting caught up in whatever the macro environment is, because the biggest challenge is that the times that you want to be investing the most is the times that it feels the hardest, and vice versa.
And just to take a step off that, investing can be as simple as you want to make it, or it can be as complex as you want to make it. Where do you see many people overly complicating things? Like, is there anything which stands out to you?
Yeah, we see a lot of people that come to us with portfolios, and we call this mutual fund salad, right? Where they show up and they say, here's my portfolio. I have 30 mutual funds. And you can't even ask them, say, what percent do you have in stocks? What are your exposures? They have no idea, because they've just been accumulating these, and the psychological bias have become wedding to something you own. You care more about it once you own it. So whether that's your car or your house or your stock portfolio. So we often tell people, say, look, it's okay to start from zero. You can sell everything, ignoring taxes. So if you've owned GE since the 1940s, ignore that last comment. But in general, you can sell everything and start over. And the biggest problem people have is, I think, often they pay way too much in fees. And this is even more onerous to your listeners in, say, Europe and in some countries around the world, to where indexing and low-cost pressure of like a Vanguard hasn't really caused the entire space to go down. But, I think that paying a lot in fees and become emotionally attached to your portfolio is a big one. And that's the beauty of a digital advisor. And I think you're going to see a lot more of this. And this is one of the reasons we're in the early innings of this sort of disruption, which is great for investors. And an example is this. So there's 4 ETFs that are asset allocation, global asset allocation ETFs, where we have one of them, that charge less than 0.3% per year. And they manage around $2 billion. So pretty good, right? But there's something like 600 mutual funds that charge over that amount. In some cases, it's 1%, 2%, 3% per year. They manage almost $1 trillion. And so you can see a lot of this money is still in very high fee structures and look, I'll be the first to admit, all that matters is total returns after all fees and taxes. So if you got a killer hedge fund doing something crazy that's making great returns, hey man, thumbs up. But the vast majority of managers that aren't doing anything, by definition, are meant to be lazy and buy and hold. You should be paying as little as possible. So simple takeaways, are the good news is a lot of the stuff to put into practice is very simple. So a long-term portfolio, have a plan, pay as little as you can in taxes and fees, and stick to it. That's good advice that most people can handle. And the digital advisor, the beauty of it, whether you use ours, whether you use Vanguard's, doesn't matter, is that they do it all for you. And it kind of whirs in the background. And I think particularly the younger crowd listening can certainly identify more with that a little more than the older crowd, although the average age of our investors on the digital side is in the late 40s. So perhaps maybe it's not as true as we think. But anyway, it's a wonderful time to be an investor. And I would say just be mindful of what you pay and how you implement it.
Yeah. Well, Meb, this has been really interesting. If anyone listening to this podcast maybe has some questions or they want to find out more, where would you point them? Where's the best place to go to find out more about you?
We got about 4 places. So you can watch me pick fights on Twitter at Meb Faber. We have my blog, which has thousands of posts on it. And that's just mebfaber.com. We have my 3 work sites. So there's the digital advisor is CambriaInvestments.com. The fund website is CambriaFunds.com. Our research portal is theideafarm.com. And I think I mentioned it before, but if you want to download a free book, freebook.mebfaber.com. You get to download our last book off Amazon. But lastly, just shoot me an email. More than happy to connect anytime. And if you're in Los Angeles, come look me up. We'll grab a beer or a coffee.
Cool, man. Well, I'll make sure to include all those links in one place in the show notes at chatwithtraders.com as well. So one thing you didn't mention is you've got a podcast yourself. Where can people go to find out more about that? Is that on your blog, I presume?
Yeah, blog, iTunes, Meb Faber Show, creative name. But yeah, it's been a lot of fun. And we try, if I can get around to it, put out one per week. But as you know, Aaron, it's a labor of love and it's a lot of work. So you guys make sure to go give Aaron lots of good reviews because it's a lot more work than I thought it would be. But it's been a lot of fun.
Yeah. Admittedly, I was a little bit naive going into it as well. It turned out to be a bit more work than I expected, but no, I thoroughly enjoyed it. Meb, thank you very much for coming on the podcast, man. I truly appreciate it. Yeah, thank you once again.
Been great. Let's do it again.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey crew, what's up? I hope you're doing fantastic. This week for episode 121, I have with me here Michael Mauboussin. Michael is a managing director and head of global financial strategies at Credit Suisse. He's also a professor of finance at Columbia Business School and the author of several books such as The Success Equation and More Than You Know. Michael is widely recognized as a thought leader on the subject of decision making, as well as thinking about things in the way of process over outcome and skill versus luck. And it's these 3 things which are the overarching theme of this episode. So hopefully, along the way, you're going to pick up a few good tips from Michael that will help to improve your ability of making better decisions and creating better processes as a trader. For quick links to resources mentioned during this episode, you'll find everything at chatwithtraders.com/121. Okay, thanks very much for being tuned in. Now, here is my interview with Michael Mauboussin.
And I'll just mention one other thing, Aaron. My last name is pronounced Mobison.
Okay.
Yeah. And it took me 12 years to learn that. So hopefully you can do it in 12 seconds.
I'm sure I'll manage. Yeah. No, that's fine. Excellent. Thanks for clarifying that too.
No problem.
I know a lot of people struggle with it. When I was doing a little bit of research for this interview, I came across a video on YouTube. It was like, I think your students had sort of put it together.
Oh, yeah. It was very nice.
And one of the questions that they were asked is how to pronounce your last name.
Yeah, exactly. I forgot about that, yeah.
I think every one of them struggled with it.
I told them the first day of class, but I don't know if they remember, yeah.
It didn't seem like they did. Anyway, that's cool. So, Michael, you're an authority on decision-making and related subjects, but before we get into anything too serious, can you share a little bit about your background, like prior to working with Credit Suisse?
Yeah, so I was a liberal arts major in college, so I didn't study business or finance at all formally. So when I first came to Wall Street, I was quite confused for quite a while. But I was at a training program at Drexel Burnham Lambert that was fantastic. We were allowed to not only get classroom training, but also rotate through a number of different departments in the firm, which allowed anybody to figure out what they enjoyed the most, whether it was trading or research or investment banking. And I personally really gravitated toward research, was able to parlay that into a junior analyst job, and eventually was hired at the First Boston Corporation, the precursor to Credit Suisse, in the early 1990s, was a research analyst for many years, morphed into a strategist, did that on the buy side, and then have rejoined Credit Suisse in this role in global financial strategy. So it's been a fabulous journey, but started off as a liberal arts guy focused on first principles.
And as you know, in your current role now, you are head of global financial strategies at Credit Suisse. What does this entail? What sort of things are you doing there?
Well, the primary, we talk to different constituencies, including corporations and investors, and the work we do tends to fall into one of four areas. We spend a lot of time thinking about markets and capital markets theory, and for example, recently a lot of discussion about indexing versus active management. We spend a lot of time on valuation work, so how to value businesses intelligently, a lot of work on competitive strategies, the third area, and then fourth and finally, decision making. So these are all things I think are ingredients in a thoughtful investment process. And that's probably the most overarching title for what we do is working on and improving any investment process.
And throughout this time, you've also been teaching at Columbia Business School. Is that right? I think you teach, is it security analysts?
Security analysis, yeah, and now we're on spring break. It's hard to tell from the snow outside here in the northeast of the United States, but we're on spring break. So yeah, this is my 25th consecutive year teaching security analysis, which is fabulous. And what I always like to say, teaching really it compels one to clarify their thinking, and also allows me at least to keep one foot on sort of the academic platform as well as a practitioner platform. So trying to take the best of what academics do and the best of practitioners do and avoid the worst of both of those worlds.
Sure, yeah. Well, Michael, we've got a lot to talk about here, so let's get right into decision making. I'm not really sure what the best question to start this topic is, but let's start with how should we think about decision making and how can one judge the quality of their decisions?
Yeah, so I think that the overarching concept here is that through work by folks like Danny Kahneman and Amos Tversky and many other psychologists, we've discovered that as individuals, we often don't make the best decisions. We often rely on heuristics, rules of thumb, which lead to certain biases, and there should be ways to do all these things a little bit better. So for me, the first step in all of this is to become familiar with that work and to understand where our own cognitive limitations are likely to fall. As for auditing the quality of your decisions, it's a really crucial issue. And I always like to say, if you're in a probabilistic field, and I know, Aaron, you're very familiar with this, but if you're in a probabilistic field, the point of emphasis should really be on the process of your decision making, so that given the information you had at a time, that you're making the proper choice rather than solely the outcome. And I think that as humans, we tend to focus a lot on outcomes, and we tend to associate good outcomes with good process and bad outcomes with bad process. But if there's a heavy dose of luck or some sort of realm of probability,
It really does have to be the focus has to be the process. So to me, that's really the best way to try to audit the quality of your decisions is to document how you thought about it, what your process was. And then I do think if you do that well over time, certainly the outcomes will be to your liking.
Now, you said one of the things there is to be aware of your cognitive limitations. Would you mind expanding on that just a little bit?
Sure. So I think that there are two big threads to the Kahneman and Tversky work. The first thread has to do with called heuristics and biases, which is what you asked about, and the second is on prospect theory, which is how some of our behaviors depart from what would be normative economic theory. So going back to heuristics and biases, the idea is that we operate with shorthands, and those shorthands often lead to biases that lead to decisions that might not be as good as they could be. Let me just give you maybe three examples from that world that I think would be relevant for investors or even people watching sports or something else. The first is called overconfidence, which has been very well done. It's actually quite easy to document that people tend to be overconfident in their own abilities and views of things. And one of the major manifestations of that is that people tend to project outcomes in the future that are vastly too narrow given the circumstances. So people fail to anticipate the range of outcomes that are plausible. So overconfidence can be very deleterious for that reason. A second one is called confirmation bias. And this is, if you're an investor, you've done this. And confirmation bias says once you've made a decision, even if you struggled to make that decision, once you've made that decision, we all tend to seek information that confirms our point of view, and we dismiss or discount or disavow information that doesn't confirm our view. So in effect, we don't let new information in the door. And what we know also in the decision-making literature is that really what you want to do is have a prior view of the world and update that as new information comes in. Confirmation bias tends to block that process. So that's another really important one to bear in mind. The third one is called recency bias, which means we tend to weight recent events much more than we do appropriate sample sizes for things. So, if an athlete has had a particularly good stretch, we tend to extrapolate his or her performance versus looking at the entire body of that athlete's performance and trying to understand exactly what their likely match is like to be or their next outcome is going to be. So those are three examples of very specific things, all of which I think are relevant for investors, but really people in all decision domains for sure.
Let's pick up on that point, bias, because I think that's really important. There are times when we have our minds made up before properly thinking things through, and looking over all the facts. What should someone do when they find themselves in this position, like when they actually realize that they do have some sort of confirmation bias? What's the best thing to do in that situation?
Aaron, I think that the simplest answer to that is to always have an open mind and to always keep all of your views or make your views somewhat tenuous. There's a psychologist, University of Pennsylvania, Phil Tetlock, who's got a great line. He says, beliefs are theories, basically, hypotheses to be tested, not treasures to be protected, right? Beliefs are hypotheses to be tested, not treasures to be protected. And I think that sort of encapsulates the thought really well. So the idea is to keep an open mind and be actively open-minded about new input. And then if I want to be a little bit of a nerd or be a little bit more formal, the structured way to do this is through Bayes' theorem. So Bayes' theorem is a mathematical way to take new information and to update your point of view. So clearly, to begin, you want to go in the right direction, right? So make sure you're strengthening or weakening your probabilities. And then secondly, if you can go to the right magnitude, that's great. So the first part is open-mindedness. And second, if you want to be slightly more formal, it's the application of ideas behind Bayes' theorem to improve the quality of your new views.
Can Bayes' theorem, I know of it, but that's kind of about where it ends. So yeah, I'm aware it's a math thing, very technical term there. Can that be applied to all decision making or only in some circumstances?
Yeah, I think it applies to most everything, and I think that while the math of it can be maybe daunting to some people, the basic principle is very straightforward, which is, you woke up this morning with a set of beliefs about the world, and new information came across the transom. And the question is, did you, or is it appropriate for you to change your views given the new information that's come in, right? So the subtleties are knowing, again, which direction to move in and knowing the magnitude in which to work. Now, I have to say to you that many people are actually very skillful forecasters, for instance, are aware of Bayes' theorem, but they don't actually formally use it. So I think that it's less about the formal application of the mathematical model and much more about the awareness that every view you have should be somewhat tenuous and that you should be ready when the evidence dictates to change your view. So, the fact is that once we've made up our minds on things, we like to be right, and we don't really like to work at it. So we'd rather just not have to deal with it and just pretend like we've got it correct. And as you know, these are actually not only in the world of investing, but also very, very important in the world of business, and certainly we're seeing around the world very important for politics as well. So this is I think it's an overarching theme of updating views appropriately based on new information.
Yeah, and as we're talking about biases here, are there any other biases which you think we need to be aware of when it comes to decision making? And is there ever times when some bias is useful?
Well, there are many. I think you document them. There could be dozens of them, right? So we go on and on about it. Another example is framing. So, for instance, Aaron, the way I present a problem to you, I could present two mathematically equivalent problems to you, but the way I presented them could skew the way you would decide, right? Or I could get you to choose one versus the other, even though they're mathematically the same. So that's the kind of thing. Framing is another good example of that. I'm not sure that there are cases where biases work for you, right? By definition, a bias we're saying is something that's a departure from what would be ideal. But that said, I think it's very important to acknowledge that sometimes our rules of thumb work quite well. And in many instances, they work quite well. And in particular, your intuitions can be very robust in realms that are stable and realms that are linear, right? So if you practice in a stable or linear realm, you can develop and cultivate an intuition that's actually quite useful. And, the classic example of that would be chess players. You show a chessboard to a master or grandmaster, he or she very quickly knows which players have the advantage. They can figure out good or even great moves very quickly, and even athletes to do a lot of this to some degree. But that's the real litmus test is where these kinds of things, where your intuition works, is relates to the stability and linearity of the environment. And that's an interesting question as regards to business and investing, because there's probably some components of it that are fairly predictable, but other components that are much less predictable. So you have to be more guarded about relying solely or exclusively on your intuition.
Okay, and just so we're clear, when you mention a steady realm or a linear realm, what's an example of each of those? I know you mentioned the chessboard there. I'm not sure which one that fits into.
Well, I think chess is both, right? Stable and linear, in the sense that the pieces move the same way. It's an open information game and so forth. And there are no nonlinear effects, right? So, that would be that example. But even things like non-stable, nonlinear effects, by the way, even simple things like phase transition. So the most basic phase transition is a physical example. So if you take water and it's at 2 degrees Celsius and you take it to 0 degrees or minus 1 degree Celsius, it goes from liquid to solid, right? So that's a phase transition. It's a small change, incremental change in temperature leads to a very different change in the actual nature of the system. So those kinds of things tend to be very difficult for prediction, and when they're out not when it's just water freezing, but we're out in the real world. So and you could think about this even like you're driving your automobile. So when you drove into work today, you mostly had stable and linear environment, but there could be extreme instances for your driving, for instance, that you would probably be out of your league in terms of comfort, right?
How do you try to reduce the influence of emotion in decision making? I know this is somewhat related to bias, but I think emotion is maybe slightly different. How do you try to reduce the emotion influence in decision making, particularly when the result of that decision is something that we greatly desire?
Yeah, it's a great question, and part of the answer I think relates to things like checklists. So if you're in an activity that lends itself to a checklist that allow you to be methodical, every time you make a decision, that tends to be a good thing. So, for example, the classic example is pilots, right? So you would not think of getting on an airplane unless the pilot had gone through his or her preparedness checklist. And that allows for that consistency, and whether that pilot's having sort of a good day or a bad day, if they've dealt with the full checklist appropriately, you're going to fly safely. Now, what's also interesting when you tie in the emotional component, they're really often talked about two different types of checklists. One is called do confirm, and that means you basically do your job as you normally do, and then you pause periodically to confirm that you've covered all the things you're supposed to cover. And pilots, they do confirm checklists. The second kind of checklist is called read do, and this is when you're in an emergency. So now you're the pilot and you're flying your 777, and one of the engines goes out. Right, so it's not a good situation. It tends to lead to emotional arousal. And the redo checklist basically says, left engine out on 777. Here are the following 5 things you should do in this order. So it allows you to act, again, because people know it allows you to act without worrying about your emotional arousal to get to the most satisfactory solution as quickly as possible. And I have to say, in much of our work, to bring this to the world of investing, we wrote a piece called Managing the Man Overboard Moment about when a stock is down 10% versus the market. And again, very high emotional arousal. We provide a redo checklist that allows the investor to sit down, calmly go through at least what the history has said about those types of situations to come up with hopefully a more balanced and hopefully rational judgment as to what to do from there.
I know you've written a whole book on this, Michael, but would you mind describing what you mean when you talk about counter-intuition? Yeah.
So, by the way, I'm not even sure counter-intuition's a word. My editor decided to use that subtitle, so don't tell anybody, but I don't think it's in the dictionary. No, the idea is this, that when we're faced with certain types of situations, our minds naturally want to deal with one way when there may be a better way to deal with it. So in a sense, you have to counter your natural intuition, your natural way of doing something to come up with a better solution. So that's really where that book, Think Twice, is all, and the title is also very evocative, Think Twice. And so what I try to do in that book is lay out eight of those types of situations and provide some guidance as to how to sidestep them. So one example, and this actually ties into the man overboard, one example also popularized by Danny Kahneman is this idea called the inside-outside view. So the idea here is that if I pose a problem to you, Aaron, it could be anything. It could be, if you're a university student, when will you hand your paper in? It could be how long will it take you to remodel your kitchen and what will it cost? It could be anything. The classic way to solve that problem is to gather lots of information, to combine it with your own inputs and experience, and project into the future. And left to our own devices, that's how we all do it. The outside view, by contrast, says, I'm going to think about my problem as an instance of a larger reference class. I'm going to ask the basic question, what happened when other people were in this situation before? So rather me as the university student saying, I think I'll have my paper finished by Friday, I ask, how many students in this situation, in this position, actually got done by Friday, which is a very different question. And so it turns out thoughtful combinations of the inside and the outside view give you better predictions about what's going to happen. So that's a classic example, is if I leave you to your own device, you're going to use the inside view, but integrating thoughtfully the outside view, thinking twice, will allow you to be more accurate in what you're doing. So that's one example, but that's this idea of counterintuition, is under certain conditions, the natural flow of how you're going to want to think about it may not be optimal.
And as you brought up more information there, gathering more information, how often is more information the key to better decisions, or can this, lead to indecisiveness?
Analysis paralysis. Yeah.
Yeah. Can you speak to that a little bit?
Sure. And it's a fascinating question. And I think that, look, in some domains, more information is better for sure. But there's a very, very famous series of psychological experiments that relate to this. And the original one was done by Paul Slovic back in the 1970s, but this has been replicated quite a few times. But I'll tell you what Slovic did back in the day. So what he did, he went to people who were handicappers, so betting on horse races. And he had a menu of something like 88 pieces of information. And he said, here's what I want you to do. I want you to take some bits of this, say 5 bits of information, and place a bet, double that, place a bet, double it again, place a bet, and so forth. And so then he could examine 2 things. One was how accurate their bets were, so did the incremental information help them? And the second thing he measured, interestingly, was confidence. And what he found was the accuracy of the bets truly didn't improve much at all as the new information came in, and yet confidence tended to soar. So there's this disconnect that as people have more information, they tend to get more confident, but no more accurate. So one of the things I like to talk a lot about, and by the way, there's a logical reason for this, right? Which is something like, you prioritize. If you're a handicapper and I say, here's a menu of things you can pick from, you're going to choose the things that are most relevant to predicting a horse race, right? So there's a substantial degradation of the value of the information as it's coming in, right? So that's this interesting contrast that often more information doesn't help us, yet it does make us more confident. And then certainly if that confidence becomes misplaced, that raises the risk of again, making bad decisions or bad bets or what have you. So that is, I think that's a really interesting dynamic. The key on this analysis paralysis, that really has to do with a timeliness thing. So if you're in a situation where you have to make a decision, it's often the best to wait as long as you can before you have to make a decision, because new information may help you. But if you're in a position where you should be making decisions, that is, again, you have to just move and work with what you have. So that's where it becomes a problem.
Yeah, and one of the things I've heard you speak about is actually weighting information. How do you go about this, and how do you think about weighting information?
Yeah, I think it's it's not a super easy thing, but for example, you might take a simple example of how to think about a value of a corporation, and it's usually the case that for a particular company or a particular stock of a company, there are usually 2 or 3 variables that are hanging in the balance that you have to figure out one way or another. And the sooner you can get to those and come up with a thoughtful, differentiated point of view, the better off you're going to be. You mentioned at the beginning that I teach at Columbia Business School, and sort of the capstone of the course is the students present to real portfolio managers. So it's a very live setting. They're saying buy or sell particular stocks, and the portfolio managers are giving them feedback real time. Probably the number one thing the students hear from those professionals is, you gave me too much information, and you need to figure out what matters for that particular company or that particular industry. So this idea of prioritization is really crucial. So that's one example. Now, in one of my books, I wrote another case of things that sound impressive that are not. So for instance, we had a technology analyst who was trying to figure out whether technology spending was going to go up or down, which of course is a laudable objective. And so the analyst surveyed Fortune 1000 chief information officers. Well, if you look at and so they said, we talked to 75 of them. Well, you look at the Fortune 1000, right? It's it's a power law. It's very skewed. So just a handful of companies spend almost all the money, and the tail spends very little money. So if you're talking to, company number 200 to 1,000, they're really not moving the needle, whereas companies, 0 through 50 are really the ones that are making it happen. So that's an example of something that sounds superficially quite impressive, but unless you understand the actual contributions of the companies, you're going to get a misread on the situation.
Yeah, I think that's a really great example.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? or sat on the sidelines because your account balance felt too small to matter. Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
How do you suggest that people deal with indecisiveness? Like when you don't know what's the best thing to do? I mean, I personally think this is maybe one of my weaknesses in some ways, is that I can sometimes struggle to make a decision and I can be very indecisive sometimes, which is quite annoying. How do you suggest people deal with indecisiveness?
Yeah, I mean, a lot of that is domain, depends on the domain you're dealing with. And sometimes your indecisiveness is not, it's good, more annoying than, like if you're taking forever to order at a restaurant off the menu or sitting in Starbucks and mulling over the different beverage choices. But, the key question is, do you need to move or not? And, there are little simple techniques on things if you do need to move. A very simple technique that can get you moving a bit is just a plus minus column and just say, right, here's a decision. If I do it, here are the things that are good about it. On the minus column, here are things that are bad about it. And as you enumerate those things, you try to cross off in equal proportion the things that are equal of significance. And whatever you're left with basically says yay or nay, right? So you're forcing yourself to quantify the decision in that fashion. So that might be one way to do that. So, I don't know if there is a great answer to that, but that's one simple technique that tends to get you moving, get you thinking, and get your mental juices flowing so you can get off the fence and do something.
Sure. And are there any other exercises that one can do just in general to improve their decision-making ability?
Yeah, I mean, if you especially if you're working in a group setting, almost always the main problem is that people don't surface different alternatives. So to the degree which you have techniques to surface alternatives, that's very effective, especially in group settings. One example of that is a concept called a pre-mortem that was developed by a psychologist named Gary Klein. So we all know about post-mortems, so the patient has died or some adverse outcome, and we try to learn from our mistakes. We give them the information. We think about what we could have or should have done differently. A pre-mortem is actually a quite different exercise. It says, let's pretend we've actually made a decision today, some investment, for instance, and then we launch ourselves into the future, so now it's March of 2018, and we pretend this decision turned out very poorly, very badly. And then each of us individually